That's right. I know.
Hey, yeah, nice to meet you.
Look forward to hearing you.
Me too.
Got it. Thank you. Yeah.
Control your microphone. All right. It's on and off.
Sharpened pencil.
I know, right?
Old school. That's old school.
I'm going to manage to destroy this one pretty quickly. But,
Morning, Austin. You said
Is it?
much better off. Yeah.
Welcome, everyone. The committee will now come to order, and I want to thank all of you for coming at this important hearing. It's very timely. We see right now what is happening in the markets with cryptocurrency, which brings us to the significance and importance of this timely hearing. So thank you all for coming. Our hearing is entitled Changing Market Roles, the FTX Proposal, and Trends in New Clearinghouse Models. After a brief opening statement, members will receive testimony from our witnesses today, and then the hearing will be open up to questions. And I will begin with my opening statement. Ladies and gentlemen, this is important. I feel personally that this could be a serious threat, particularly to our derivatives market and our cross-border dealings that we've been involved with. And as we know, we're dealing with an $822 trillion piece of the world's economy. That is what's on the table here today. And primarily, it is to keep our economy, our financial system as the greatest in the world. That's what's at stake at this hearing. So I look forward, and I'm sure we'll have a robust and well-informed debate today on the merits and the suitability of the clearing model that is proposed now by FTX. This is why we're here. And I've said many times before, and I think my reputation speaks for it in my 20 years, and that is this: I have a tremendous respect, love, and admiration for our great financial system. And as chairman of our House Agriculture Committee, as well as a ranking member now, or senior member, of the House Financial Service Committee, I am particularly well suited to really deal with this emerging and worrisome threat. Maybe after today you can convince me that it's not a threat. But until then, it seems to be a threat to me, to our clearinghouses, and the derivatives market. And just as the CFT has recognized the novelty of FTX's proposal to trade margin products under a non-intermediated clearing model and the need for closer public examination, I have heard a number of concerns about the risks, about the threats of their proposed model, and I believe that we must take great caution to preserve and protect our great financial system, the protections and the international standing it affords our market participants. And that is why I have asked you, and I've brought some very distinguished individuals today, representing a variety of interests and perspectives here to ensure that we are giving this conversation the appropriate amount of attention and that all the voices on this issue will be heard this day. Earlier this year, I invited and asked Chairman Bingham of the CFTC and invited him to come and testify before our committee on the state of the CFTC. And I was heartened to hear that the CFTC Commission would offer an opportunity for robust public input on this FTX proposal. Any new and untested proposal that has widespread implications for the orderly clearing of derivatives trades must be given due and proper consideration. Make no mistake, ladies and gentlemen, while the proposed clearing model by FTX is limited in a select few cryptocurrency contracts, we must consider the potential of this model to expand into other derivatives markets and adopted in some form by other clearinghouses. Further, I am greatly concerned, and this worries me, about the potential of this proposal to upset international agreements that the CFTC and this committee have worked so hard to preserve, which have deemed our current clearing structure and regulations equivalent to EU and UK rules, affording us derivatives clearing organizations the ability to provide clearing services in their markets. I want to remind you all that a while back, as I was serving not as chairman, but chairman of the Credits and Energy and the Exchanges Subcommittee, that I, along with then Chairman Colin Peterson and Mike Conaway, who was also chairman, and my friend Austin Scott, we led a fight then to preserve the sanctity of our clearinghouses. There was a threat that the EU wanted to regulate them. We had to step in and stop that. So this is why this is very critical as we look at this. And both sides of the aisle, Democrats and Republicans, we're very concerned about that. We have the greatest financial system in the world, as I said, and we must ensure that the CFTC's regulatory safeguards governing derivatives markets help us maintain that position in the future. That's why this hearing is important. And as chairman of our House Agriculture Committee, I believe it is very important for this committee to ensure that this remains the case And I look forward to our hearing today, and I'm really looking forward to hearing our expert panelists help us as we navigate this challenging issue. And so with that now, I'll turn to our distinguished ranking member, my friend from Pennsylvania, Ranking Member Thompson, for his opening statement.
Well, thank you, Mr. Chairman. I want to acknowledge your efforts to work collaborative with me on this hearing. I especially appreciate that today's table is a bipartisan witness table, and it will be a better hearing because of our work together, so thank you very much. In 1974, when the CFTC was first established, electronic trading was so novel that Congress directed the Commodity Futures Trading Commission in statute to determine the feasibility of trading by computer. Today, of course, the idea computers would not have taken over markets seems almost laughable. Our markets exist almost entirely in computers. There are virtually no open outcry pits left anywhere in the world. But this transition didn't happen overnight. Certainly many people are responsible for the transition to electronic markets. However, we have to give credit to both CME and ICE for their pioneering work in the 1990s and the 2000s to bring the futures market into the digital age. The benefits of this technology have been enormous. Today, computers and capital work together to deepen liquidity, narrow spreads, reduce transaction times, and create new hedging opportunities. Electronic trading provides greater access and availability to all market participants. But in the eyes of some, it also has some drawbacks. Certainly, the men and women put out of work might have mixed feelings. And to this day, a few market participants continue to believe that electronic markets are more volatile and less reliable than human intermediated markets. Now, since moving markets to the screen, the technology underpinning our markets has not stood still. Just last year, CME Group announced it's undertaking the next step in electronic markets by migrating to the cloud. And like the move to electronic trading, their proposal could be both beneficial and disruptive to the markets. Cloud-based infrastructure could be another revolution in leveling the playing field for market access and reducing costs for participants while also upending how existing participants interact with exchanges. Now, today we're going to hear about another proposal, proposed market innovation, a recent proposal from FTX to expand their current non-intermediated clearinghouse to offer margin products. And this proposal has generated excitement, concern, hope, and confusion. Sounds like Washington, actually. You get all four of those emotions going at once. That's the kind of world we work and live in sometimes, huh? But we acknowledge that. And this proposal has generated all of that. And as I've said in the past, proposal has generated, again, all of those emotions across the derivatives and the crypto industries. And as I've said in the past, I believe this proposal is worthy of balanced consideration. Now, I know the Commission is working diligently to consider it. A few weeks ago, Chairman Benham sat before us in this very room. Thank you for that hearing, that opportunity, and explained his process. Specifically, he committed to us that the Commission will consider, as they do every proposal, the proposal publicly, according to the core principles for a derivatives clearing organization. Chairman Benham also committed to a comment period, which closed yesterday, and to hold a public roundtable, which will be held, which will take place at the end of the month. Now, I don't believe this committee should duplicate that work. We have empowered the CFTC, the Commission, and the commissioners to ensure stakeholders and the public will have a seat at the table, and now we must trust the process. Where the Commission fails to consider the proposal appropriately, deviates from the law, or unnecessarily limits debate, we should not hesitate to weigh in, but that has not happened. For me, the most interesting part of today's testimony will be a broader conversation about changing market structure and the ever-evolving impact of technology on markets. Now, sometimes at a crawl, and sometimes in leaps and bounds. Technological innovation is revolutionizing the world around us. Now, I hope we can discuss how technology can continue to empower market participants by reducing costs, improving access, and protecting our financial markets by increasing transparency and reducing systemic risk. Now, we have the largest, most liquid, most dynamic derivative markets in the world because the potential for innovation is baked into our regulatory structure. In the end, it is the market participants and ultimately the American people who will benefit from the quality of these markets. Protecting and promoting the health of our markets is what should drive each of our regulatory decisions. And I want to say a warm welcome to all of our witnesses and thank all of them for their diligence in preparing for today, and I look forward to your testimony. And with that, Mr. Chairman, I yield back.
Thank you, Ranking Member. The chair would request that our other members submit their opening statements for the record so our witnesses may begin their testimony and to ensure that we have ample time for everyone to ask questions and our witnesses time to give good, thorough answers. And now it's my pleasure to introduce our distinguished panel. Our first witness today is Mr. Terry Duffy. Mr. Duffy is the chairman and chief executive officer of the CME Group. Our next witness today is Mr. Sam Bankman-Freed, who is the chief executive officer and founder of the FTX U.S. derivatives. And our third witness today is Mr. Walt Lukin, the president and chief executive officer of the Futures Industry Association. And our fourth witness today is Mr. Christopher Edmonds, the Chief Development Officer of the Intercontinental Exchange. And our fifth and final witness today is Mr. Christopher Perkins, the President of Coin Fund Management, LLC. Welcome to all of you. Thank you for coming. And now we'll get right to the testimonies. And Mr. Duffy, you will be first. Please begin when you're ready.
Well, thank you, Mr. Chairman and Ranking Member Thompson, for holding this hearing today. It's a great pleasure to be back in this body. I haven't been here in several years, and it's wonderful to be in person with all of you again, and hope you and your families are all healthy and doing well. As the Chairman said, my name is Terry Duffy. I'm the Chairman and Chief Executive Officer of CME Group, the world's leading derivatives marketplace, offering futures and options contracts across every investable asset class. Risk management and innovation are hallmarks of CME Group and have always been fundamental to centrally cleared derivatives markets in the United States. Under false claims of innovation that are little more than cost-cutting measures, FTX is proposing a risk management light clearing regime that would inject significant systemic risk into the U.S. financial system. The FTX model would come at the expense of proven risk mitigation practices, market integrity, and ultimately financial stability. In fact, the FTX proposal would significantly increase market risk by potentially removing up to $170 billion of loss-absorbing capital from the cleared derivatives market, eliminating standard credit due diligence practices, and perhaps most importantly, destroying risk management incentives by eliminating stakeholder capital requirements and mutualized risk. The FTX proposal to instantaneously auto-liquidate any customer who is under margin at any given moment in time would jeopardize both market integrity and financial stability. Auto-liquidation can exacerbate volatility and create dramatic price moves during times of turbulence. In an already stressed market, these automated liquidations could lead to a repeated pattern of price declines followed by additional liquidations. This has the potential to build losses on top of losses and destabilize markets for all participants. Furthermore, FTX's market maker and backstop liquidity provider plans, imported from its offshore practices in low regulatory jurisdictions, raises serious questions about the potential conflicts of interest embedded in the FTX model. Finally, the FTX proposal eliminates critical customer protections. Under their model, market participants will lose important customer segregation protections and could be exposed to increased collateral investment losses. And non-defaulting customer positions let me repeat that, non-defaulting customer positions could be terminated or collateral liquidated at the discretion of first line of defense against losses for any reason under any market condition. By contrast, U.S. clearinghouses like CME Clearing have billions of dollars of resources available in the default waterfall that must be used to cover losses prior to any possibility of a position tear-up. The FTX proposal is not innovation. It's an invasion of best practices in prudent risk management. And while the Commodity Exchange Act may promote innovation, it does not promote innovation for the sake of innovation alone. In order to approve the FTX proposal, the CFTC must determine that it complies with the core principles and is in the public's best interests. We do not see how the Commission could credibly make this finding or legally limit its approval, even on a test basis, to crypto only. If the Commission makes its finding for crypto markets, they will not be able to keep FTX or others from expanding into other asset classes. To suggest otherwise would put all market participants at an extreme disadvantage. Market structure changes would affect the entire industry, not just FTX. And all platforms must be able to participate under the same rules at the same time. Accordingly, the CFTC should either reject the FTX proposal or commence a formal rulemaking to allow a broader public discussion of appropriate risk management standards. In conclusion, let me make one final point. As you know better than anyone, Chairman Scott, you and this committee have spent enormous time, you mentioned it in your opening remarks, and energy defending the CFTC standards and regulatory oversight as equal to or better than any other jurisdiction in the world. If, in fact, the CFTC decides to approve a rushed and ill-conceived proposal, we believe the hard-won cross-border equivalence agreement that you referred to could come under question. Just a few weeks ago, sir, a senior European central bank official warned, and I quote, "The crypto market is now larger than the subprime mortgage market was when it triggered the global financial crisis." To put this into context, the subprime mortgage market was at $1.8 trillion in 2008. Today, the cryptocurrency value is north of $1.8 trillion and growing. The stakes are extremely high. Exempting FTX from a well-established U.S. clearing rules can undermine confidence in our regulatory regime. Therefore, I applaud you, Mr. Chairman, and this committee for holding this hearing today. Your oversight of the derivatives marketplace structure is critical to ensuring sound public policy. Mr. Chairman, Ranking Member, members of the committee, I thank you. I look forward to answering your questions.
Thank you. Mr. Bankman-Freed, please begin when you're ready.
Chairman Scott, Ranking Member Thompson, members of the committee, thank you so much for having me here today. A bit about myself: I went to MIT, majored in physics. I worked on Wall Street at Jane Street Capital with the goal of donating what I made. And I got involved in the digital asset ecosystem in 2017. In 2019, I founded FTX, a global cryptocurrency derivatives exchange. In 2020, we launched our US arm, FTX US. And in 2021, we acquired LedgerX, now FTX US Derivatives, a CFTC-licensed clearinghouse and marketplace. Last year, we submitted an amendment to our clearing order, which would allow us to operate as almost every other clearinghouse does, with margin. We have spent tens of thousands of hours talking with the Commission about this proposal and thousands of pages of documents. We really, really deeply respect the thorough process that the CFTC has undergone, the amount of time that they have spent digging into the details of our proposal, challenging it where appropriate, and the seriousness with which they are treating this proposal. We respect the CFTC and their process and whatever conclusions they ultimately come to. I will note that while our proposal does combine things together in a way that I think might bring powerful innovation to the space, each of the elements already exists in CFTC-licensed derivatives exchanges, including ICE NGX, LedgerX, and others. I believe that the amendment that we put forward would help promote healthy markets. I think that would promote fair and equitable access to platforms. In particular, traditional exchanges charge for market data such that only the largest traders are able to get full knowledge of the markets that they are supposed to be trading on. With FTX, all of our market data is 100% free, transparent, and public. All users, regulators, and other observers have full access to our market data. Traditional exchanges have separate models for the largest traders and for other users such that only the largest traders have direct access with lower latency fees and more options. We would have equitable access to our platform where all users can choose the method of access that they most prefer and have access to the most powerful tools. We also have strong customer protections under our model. It is a safe and conservative risk model, which would have helped to alleviate some of the instances that we've seen with recent future exchanges, like the LME nickel fiasco earlier this year, by having the collateral pre-funded at the clearinghouse rather than relying on credit, and having a real-time risk engine. We also have enhanced customer protections. We have all of the customer protections that exist on traditional futures exchanges and on FCMs, because we understand deeply that we have a responsibility to ensure that if there is direct access to the platform, that users are still afforded the same level of protection. On top of that, we have further customer protections, suitability, and transparency than what you find on most other platforms. Finally, we believe that this would bring competition and innovation. It would bring liquidity to the US marketplace and options to US consumers. It would bring competition in the futures market, where almost all of the volume is traded by just 2 exchanges. And it would bring competitiveness to the United States with respect to the rest of the world. Today, 95% of digital asset volume trades overseas. And that brings me to some of the broader context here. Digital asset marketplaces need federal oversight. They need that oversight to protect consumers, to protect against systemic risk, to bring liquidity back onshore, to ensure US competitiveness globally. This is good for the US economy, for Americans, for wealth creation, and good for our consumers. The CFTC is an appropriate regulator to provide this for digital asset futures contracts. They have been doing so on CME and other platforms for a number of years. They're a thorough regulator who understands this space very deeply. Thank you to the committee for having me today, and thank you for all of the work that you have put in to providing oversight and guidance on this ecosystem. And I look forward to your questions.
Thank you. And now, Mr. Lukin, please begin when you're ready.
Chairman Scott, Leader Thompson, and members of the committee, thank you for the opportunity to testify. It is indeed great to be back in this committee room. I am President and CEO of FIA, a leading global trade organization for the futures, options, and centrally cleared derivatives markets. And today, indeed, is a healthy dialogue for our industry. As someone who has served as CFTC acting chair and commissioner, I'm proud of the CFTC's mission to not only uphold strong customer protections and police the integrity of the markets, but also promote responsible innovation and fair competition among market participants. In crafting this balanced mission, Congress and this committee were careful in making sure innovation and competition were advanced responsibly and fairly, without jeopardizing the integrity or financial stability of our markets or the protections afforded to customers. Today, we are at an inflection point that requires us to carefully consider the benefits of an alternative clearing structure and ensure it does not compromise the battle-tested protections and checks of the existing clearing model. The CFTC is now considering a proposal by FTX that would replace the traditional clearing model that distributes risk using futures commission merchants with a more automated and centralized one. Specifically, the FTX direct clearing proposal would, for the first time, combine margin futures with near real-time margining, 24/7 auto liquidation of under-margined customers, and a self-funded CCP default fund without the benefits of FCMs managing, underwriting, and mutualizing customer risk. It's important to point out that the FTX proposal would permit futures trading in any underlying asset class transacted by any type of customer, including commercial hedgers. This requires us to view this proposal with an eye beyond retail cryptocurrencies. We must also consider the core users of our markets, including farmers, refiners, pension funds, and other Main Street businesses that use futures to hedge price risk in the real economy. When contemplating such transformative change, FIA encourages policymakers to consider the fundamental guiding framework articulated in President Biden's recent executive order on digital assets. Same business, same risks, same rules. FIA believes the CFTC must analyze FTX's proposal against the important customer protections and risk management functions that registered FCMs currently provide the marketplace. As agents for their customers, FCMs hold various regulatory responsibilities, including vetting customers on the appropriateness of these leveraged products, policing clients for money laundering, segregating customer funds, guaranteeing customer trades, holding significant regulatory capital against those trades, contributing to clearinghouse default funds, and agreeing to further assessments should the CCP default fund need replenishment. Today, U.S. registered FCMs contribute more than $15 billion to CCP default funds and hold an additional $175 billion of their own regulatory capital. This layer of financial resources backstops the potential default of customers and protects the markets and the wider financial system from a contagion event. FI believes there needs to be further analysis of the FTX risk model in extreme but plausible scenarios, especially for large commercial participants in other asset classes beyond retail cryptocurrencies. Given the model relies on continuous liquid markets that are open 24/7, questions remain around the market impact of auto liquidation feature for closeout of large positions in less liquid markets. We must ensure that the model does not trigger a broader fire sale in the central price discovery market that harms hedgers and exacerbates further market disruption. To conclude, FIA supports efforts to further advance real-time risk management and clearing and bring greater competition to the markets. The FTX proposal has advanced a healthy debate in our industry. However, we believe that further analysis and information are needed on the FTX proposal, and we look forward to the deliberative process of the CFTC that will help bring additional clarity and information to this unique clearing model. Thank you, Mr. Chairman.
Thank you, Mr. Lukin. And now, Mr. Edmonds, please begin when you're ready.
Thank you, sir. Chairman Scott, Ranking Member Thompson, committee members. I'm Chris Edmonds, Chief Development Officer at Intercontinental Exchange, or ICE. I have responsibility for all of ICE's clearinghouses and risk teams. I appreciate the opportunity to appear before you today to discuss the important role of clearing and the pending FTX application at the Commodity Futures Trading Commission. The U.S. is a global leader in capital and derivatives markets, enabling participants to hedge risk and manage their businesses. Throughout the market's history, there have been new and innovative technology-based ideas promising multiple efficiencies. ICE has a robust history of innovation. However, the adoption of new technology and processes comes with the potential risk for unintended consequences. Innovation cannot supersede the primary functions of futures markets for price discovery and hedging. As articulated by the leadership at FTX, the company's technology, risk management processes, and proposed regulatory framework have been constructed to revolutionize clearing and address purported issues with the current offerings. ICE is fully supportive of using new technology to deliver more efficient markets, but as policymakers examine this application, they must remain mindful of the risk. As this committee is aware, years ago, executives from Enron stood in these halls before regulators offering new ideas as to how markets should operate. Under the current system codified by the Dodd-Frank Act, separately capitalized, governed, and regulated clearing organizations manage settlement of financial transactions executed by market participants, typically via regulated clearing members. All of these participants serve important checks in the system against excessive leverage, new products that are not well tested or appropriate for widespread use, and the introduction of unexpected counterparty risk. ICE believes these independent stakeholders provide significant benefits to helping deliver market consensus. Regulated clearinghouses working in conjunction with regulated exchanges, and in most cases, market intermediaries, increase stakeholder confidence in fair markets, transparent pricing, and fully understood settlement processes. FTX plays a leading role in the markets for digital assets, and regulatory oversight will help lead to decision-making and risk management practices that are balanced. However, we do have concerns with the approach FTX has proposed with this application. Rather than following global guidelines and existing regulations, FTX has requested a new set of rules not currently compliant with CFTC regulations and global standards, and potentially sets dangerous precedents. FTX's applications raises significant questions around risk management, financial resources, investors' protections, and the collection and safeguarding of margin on non-intermediated clearing model that today has significant participation. ICE recommends the committee explore the risks raised by us and others with the application and the potential market implications. Given my 25 years of experience in these markets, I am confident no member of this committee wants to learn of constituents losing their hedge protection because the market moved against them at 3 a.m. on a Saturday morning. The current system is a pay-as-you-go system, whereas the FTX application is a go-as-you-pay service, meaning participants automatically lose their position if the market moves against them without the ability to bolster their stake with additional margin. The upshot of these model differences has the potential to impact users of future markets significantly and detrimentally. This committee should continue its globally recognized leadership in market structure when evaluating the proposal. Approval in its current form may lead other jurisdictions to challenge the pragmatic, principle-based approach the CFTC has championed. ICE has embraced competition from our founding, and we do not believe there is a single model for clearing that is appropriate for all products and markets. ICE operates traditional intermediated clearing for futures exchanges and over-the-counter derivative markets, as well as non-intermediated clearing for certain energy products used by commercial and institutional market participants. In all cases, ICE clearinghouses are compliant with global regulatory standards and CFTC rules as written today, and did not require new CFTC rulebooks to be successful. I appreciate this opportunity to appear before you today and look forward to answering any questions the members of the committee may have. Thank you.
Thank you. And now, Mr. Perkins, you're recognized for 5 minutes.
Chairman Scott, Ranking Member Thompson, members of the committee, and distinguished guests, thank you for giving me the opportunity to testify before this committee today. It is an honor and a privilege to share my perspective on how America can embrace innovation and the promise of Web3 to reinforce our leadership in the global financial system, while doing so responsibly in a manner that protects investors and manages risk. I serve as president of Coin Fund Management, LLC, a Web3-focused registered investment advisor founded in 2015. Prior to this role, I served as the global co-head of the futures, clearing, and foreign exchange prime brokerage businesses at Citi, and also served on the executive committee and board of directors of the FIA. My views on risk management were initially shaped on the battlefield in Al-Ramadi, Iraq, where I had the honor of serving as a United States Marine. I subsequently transitioned to Lehman Brothers, where I witnessed firsthand the perils of unregulated, highly speculative derivatives markets that brought the global financial system to its knees. For over a decade that followed, I worked closely with global regulators and policymakers to implement reforms to the derivatives industry, and in the process, worked with my team to build one of the most prominent intermediary derivatives businesses in the world. I see the cultivation of deep, liquid, accessible, and secure derivatives markets as an important cornerstone of our economy and an essential pillar of effective risk management. The arrival of Web3 could potentially transform the global economy into a more creator-led, open, inclusive, and democratic ecosystem, aligning perfectly with shared, bipartisan American values. With principles-based, transparent, and predictable policy and regulation, the U.S. will empower entrepreneurs to build and innovate onshore, which will fuel the economy, catalyze job creation, and reinforce U.S. leadership across the global financial markets. Like it or not, the risk management realities and challenges of digital asset markets that function 24 hours a day, 7 days a week have arrived. According to a recent poll by NBC News, 1 in 5 Americans have invested in, traded, or used cryptocurrencies. The cryptocurrency market that is emerging is a more inclusive one, with communities of color leading user adoption. Today, these communities can legally take risk via exposure to a vast array of spot digital assets, but their ability to hedge that risk through the derivatives market is extremely limited. because the legacy intermediated derivatives market structure is unprepared to support the risk management realities of the digital asset class. However, the FTX proposal to allow direct access derivatives clearing powered by real-time risk and collateralization engines promises to bring much-needed innovation to U.S. digital asset derivative markets. From my perspective, the FTX proposal, if adopted, would reduce systemic risk through real-time collateralization and risk management, offer industry participants the ability to more dynamically hedge digital asset risk, introduce incremental competition and choice, which will facilitate a more inclusive, cost-effective marketplace, and revitalize U.S. digital asset derivative markets at a time when leadership and innovation have migrated overseas. Certainly, there are risks to deploying new technologies, and any proposed model must prove that it can meet and exceed the same extreme but plausible stress scenarios applied to legacy clearinghouses via existing regulation. Moreover, appropriate disclosures must ensure that industry participants clearly and transparently understand the unique nuances and risks of participating in a direct clearing model, including the risk of liquidation. Finally, guardrails to dissuade excessive speculation, as they exist today in traditional futures markets, should continue to be considered by regulators. Appropriately implemented, the direct model proposed by FTX could catalyze a new era of responsible innovation and unlock new capabilities to hedge risk at a time when, by unofficial estimates, more than 90% of crypto derivatives activity has migrated overseas. In conclusion, I support FTX's application to offer a direct clearing model for digital asset derivatives. Direct access will foster a more inclusive and liquid derivatives market in the United States, finally giving investors the ability to access derivative markets to hedge their risk. With the appropriate regulatory guardrails in place, this model will result in a more resilient, efficient, and dynamic system. I look forward to your questions today, and thank you.
Thank you very much, and I want to thank all 5 of our very distinguished members on the panel for your excellent testimonies. At this time, members will be recognized for questions in order of seniority, alternating between majority and minority members. And you will be recognized for 5 minutes each in order to allow us to get as many questions in as possible. And as I always say, please keep your microphones muted until you are ready to ask your question so that we can minimize background noise. And now I recognize myself for 5 minutes. Let me start with, we all know that the cryptocurrency is a volatile market. We realize that. We witness what has been happening to them over the past few days on the markets. And so I want to be able to ask Mr. Lukin, Mr. Duffy, and Mr. Bankman-Freed this question. And then, Mr. Edmonds, I have a question for you as well. So first, to the 3 of you, Mr. Lukin, Mr. Bankman-Freed, and Mr. Duffy, how, in your own words, is this proposal not making an already risky market much riskier for the customer, particularly in light of what we are seeing and, as several of you pointed out, the emergence of an eagerness to get into this market from the public? Mr. Duffy, would you start off?
Be happy to start. How is this adding more risk to the system? Well, you know, the gentleman at the end of the table said that 90% of the crypto market is going overseas. I would assure you that 90% of the losses are also going overseas with them. And that's not a bad thing from our perspective of our participants being protected from this. Listen, these asset classes are completely different, and I'm not here to discuss the value of crypto one way or another. I think what's important is the structure that they operate under. The proposal as put forth is fraught with dangers. The traditional clearing model that we deploy at CME Group is something that we are passionate about, and the gentleman referred to the derivatives industry cratering in 2008 and what caused that. I assure you it wasn't listed derivatives industry. It was levered bilateral derivatives that caused that collapse. So the risk associated with these products, if not properly regulated, could be catastrophic, not only for the risk of their products, but other products that this application could be applied to, especially every asset class that CME trades. So I have grave concerns. I could talk for hours on this topic, Mr. Chairman. I'll reserve my time, but I think as you deploy this against other asset classes, that's where the real risks come in.
Thank you. Mr. Lukin, please.
Well, as far as customer protection, I mean, the FCM over the years has played a critical role in our ecosystem of making sure that customers are protected, their funds are segregated, that they're guaranteeing those funds, they're holding capital in case there's a default. So we have this layer of protection, as was noted, that helps protect customers that exist that's being taken out of the system. So yeah, I think FTX is making the argument that they can replicate that in other ways through the DCO application. But we have strong views that there's a reason that FCMs help to compartmentalize risk away from the CCP. Oftentimes they're holding that capital to try to, like a ship that may be taking on water, you close the watertight hatch, right, to make sure the rest of the ship does not go down.
Right.
We think that diversified risk that the FCM provides is a helpful component of preventing a systemic event and helping protect customers.
Okay, thank you so much. Now, Mr. Bankman-Freed.
Thank you. I think that this would help make cryptocurrency markets less volatile and less risky for exactly the reasons that you guys have pointed out. The fact that there is no federal oversight of them today is not good, and providing that federal oversight with licensed cryptocurrency derivatives exchanges would help ensure that they do meet the standards and safety that we expect. And I will also say that as was referenced, financial crises can be caused by unlisted, untracked contracts done in a bespoke manner where there is no central clearing. That is another reason that we are excited to bring this under CFTC jurisdiction with CFTC oversight of the Clearinghouse.
Thank you. I just have a question, and I got to get to Mr. Edmonds. Could you comment, Mr. Edmonds, on how the clearinghouse model proposed by FTX stands up to international regulatory standards, such as those required to maintain equivalency with the EU and the UK markets?
Mr. Chairman, the EU and the UK both have made the statement, if it's the same risk, it's the same rules. And so I believe what you're asking for is, you're asking me to determine what happens if the application is approved under the current rules. We, and Mr. Duffy's made this in his testimony, don't believe it can be approved in its current form under the current rules. So we'd get a point where it's not the same rules for the same risk, and I think that's the concern on the international community.
Thank you very much. And now I recognize the ranking member, the gentleman from Pennsylvania, my friend, Mr. Thompson.
Chairman, thank you. Thank you to all of our witnesses. Mr. Bankman-Freed, thank you for speaking with us today regarding your proposal that is before the CFTC. And I know the CFTC's comment period closed yesterday, and it's holding a roundtable in a couple weeks. And its experts will give careful consideration to all the information provided. I appreciate you taking the time to provide some additional color on your proposal and to address some of the concerns expressed by some market participants. Could you please tell us why the market should deviate from the well-tested approach to clearing employed at CME for ICE for this virtually unknown approach, and why take the risk?
Thank you. So first of all, I think that there should be allowed diversity of risk models so long as they are all deemed suitable and consistent with regulations by the CFTC. I personally believe that our application is consistent with the current rules and regulations of the CFTC, that there is no required rulemaking or changes for it, and that should the CFTC deem it to be appropriate, and then it would be, it would not require any changes. I'd also like to, in terms of why I think this is worth doing, and again, I don't think that we should be banning other risk models here. I don't think we should be stopping other exchanges from being able to operate. I think we should have healthy competition here. I think that it has numerous advantages. In our risk model, the collateral is held directly at the clearinghouses. The collateral for all of the positions there is CFTC oversight of that collateral. It is guaranteed to be there, to not be used for anything else, to be segregated. And that is a difference with traditional models, provides an extra layer of security and guarantee of the assets backing these positions. I also think that having a faster risk model is appropriate for digital assets. This means that rather than having to choose between liquidating a position too early out of fear of what could happen over the next 2 days, or exposing yourself to systemic risk like we saw with LME, that the risk model can make a real-time, more precise judgment about the health of a position. I think both of those are going to be healthy, and I think they particularly fit the digital asset ecosystem. I will note that we do not have any plans to launch non-digital asset contracts anytime soon through this model. And I think those are both advantages. I think the equitable access is an advantage. I think that the open and transparent market data is an advantage. I think that all of those have real advantages. And again, I don't believe that this is inconsistent or new from the perspective of the rules or regulations that it would require. And many of the people in the industry, including many of those on this panel today, are currently listing products with many of these properties.
Okay, thank you. Mr. Perkins, your testimony, you highlight some of what you perceive as inefficiencies in the existing intermediated clearing approach. Besides a wholesale adoption of the FTX approach to clearing, what aspects of their proposal do you think today's clearinghouses should consider adopting?
Thank you, sir, for the question. In today's model, there's a mismatch between 24-hour, 7 markets of cryptocurrency with the way we collateralize today in the futures markets. So essentially, clients put on risk, we meet those obligations to the clearinghouse immediately, and then we have to wait to the following day to receive that collateral back from our clients. That doesn't reconcile with a highly volatile market that is moving. And so therefore, it's much better, we're much better positioned from a systemic risk perspective if we're able to meet that collateralization in real time. And so the inefficiency that I'm highlighting is the inefficiency of collateralization today that the FTX model addresses. And frankly, I don't see a way that the current intermediated model can deliver inclusion and provide services for crypto derivatives because of this collateral mismatch.
Thank you. Mr. Edmonds, your testimony, you noted that innovation cannot supersede the primary functions of future markets for price discovery and hedging. But even today, some innovations most take for granted, like electronic order books, algorithmic trading. My question is, what is the line between bad innovation and good innovation?
Well, I think the bright line is, where does it fit within the regulatory construct? And if the markets look for certainty at the end of the day, users of the markets look for certainty at the end of the day. And so having potentially 2 standards that may develop over time creates uncertainty in the market. And I think if you look at some of the volatility around the crypto world as it sits today, it's a lack of certainty of what happens in different jurisdictions and how folks review that. So for me, it's about how do you divide the world of regulation to make sure that those who are going to be in the game understand the rules of the game at all times.
Very good. Thank you. Thank you, all the witnesses, and thank you, Chairman.
Thank you, Ranking Member. And now the gentlewoman from North Carolina, Ms. Adams, who is also the Vice Chair of the Committee on Agriculture and is recognized for 5 minutes.
Thank you, Chair Scott and Ranking Member Thompson, for hosting the hearing today. Thank you to the witnesses. I appreciate all of your diligence here. I want to thank the committee staff. I've heard many interesting perspectives on cryptocurrency today. Some say it needs to be defined before it's regulated, crypto or security or derivative. They also say, does it need an independent financial regulator or existing commission sufficient? So let me ask Mr. Lukin. Your organization, the Futures Industry Association, represents over 80% of futures commission merchants today. If accepted, FTX's application would alter the role of U.S. registered FCMs, proposing leverage without intermediaries. So let me ask, what will happen if the model is applied to other commodity markets? Chair Benham has opened the floor for discussions on crypto derivatives. So what will happen if the model is applied to other commodity markets? Mr. Lukin?
Well, I've indicated that it needs further analysis because it's uncertain whether the customer protections that are afforded to commercial hedgers would be the same under this model. In addition, I think that the risk model, which is used to auto-liquidating small retail cryptocurrency products, once you get into large commercial hedgers that need to get into our markets and hold large positions to make sure that their agricultural products are hedged, that they're managing price risk, trying to auto-liquidate those types of positions potentially could have disruptive effects on the marketplace. And not off-market, but those other positions will have it in the central marketplace. So again, we want to understand better how this might work for commercial hedgers. It's one thing for a snake to swallow a mouse and digest it. It's another thing for a snake to swallow a pig.
Okay,
It's
so
going to have a
let me
different.
move on. I've got some more questions, but let me just ask you and follow up. Will FTX and similar players be expected to shoulder the systemic risk that clearinghouses were traditionally responsible for? Mr. Lukin?
I'm sorry, repeat the question?
Will FTX and similar players be expected to shoulder the risks that clearinghouses were traditionally responsible for?
Yes, and that's one thing we like about the FTX proposal is they've put up their own skin in the game into their default fund, and they're willing to take that on. In doing so, however, they have wiped out a significant portion of the FCM capital that is held against the positions as well.
Okay, so let me ask Mr. Bankman-Freed, if your company's proposal is accepted, can you tell us how you plan to protect consumers who use your platform?
Absolutely. Thank you, Congresswoman. To start off with, have all of the customer protections that are typically found in DCOs and DCMs, in addition to all of the protections that are typically found in FCMs, because we acknowledge that because there is a disintermediated option, we have a duty to provide all of those controls. And so we have done deep analyses both of the rules and regulations and of existing FCMs to ensure that we have similar sets of transparency, of suitability, of disclosures. And when you bring up the anti-financial crimes perspective, we are subject to Bank Secrecy Act level KYC on FTX US derivatives as well, and have a standard know your customer anti-money laundering policy both for users and for all deposits and withdrawals of both cryptocurrencies and fiat currencies that go through the platform. Finally, we will be providing transparency around any assets, any digital assets that we do list on the platform in line with what we would expect would be helpful for consumers, going far above what the current regulations require, because we think that that is appropriate.
Okay, thank you, Mr. Duffy. Let me ask you, we cannot doubt that the skyrocketing growth seen in decentralized finance is linked to its accessibility, and so as an exchange, FTX offers equitable access and a current model that gives us data for free. So what's your philosophy on that sort of user friendliness, and how's your company prioritize financial inclusion?
Yeah, it's an interesting question, and Mr. Bankman-Freed is commenting on things that are outside of his application, so I can only comment on his application. But when we talk about...
Got 3 seconds.
Well, then,
I'm about out of time.
we have equitable access to everybody, ma'am. That's about what I can tell you. The model has worked for hundreds of years. We've amended it throughout time, and it continues to be a time-tested model.
Thank you so
and
much.
it's-
Mr.
and it's
Chairman,
open
I'm
to
out of
everyone.
time. I yield back. Thank you.
Yeah, we don't accept credit cards, though, like they.
Thank you very much. And now the gentleman from Georgia, Mr. Austin Scott, is recognized for 5 minutes.
Thank you, Mr. Chairman. And at the outset, I want to say a couple of things. One is I believe the majority of my constituents are more concerned about the price of food and energy than they are about the price of digital currencies. I don't mind telling you, I don't understand the whole crypto thing. There's a tremendous amount of mining that goes on in the area that I represent. I do not understand why it consumes so much energy or what they're actually mining. You know, but I do think the CFTC roundtable on May 25th is going to provide a lot more information and a lot more understanding for all of us on the committee, as well as you know, those who will be directly impacted by this. For me, the issue is, and I majored in risk management and insurance, and actually had my Series 7 before being elected to Congress. Is does the risk outweigh the return? And I look at Coin Fund, and I go to your webpage, and it says disruptive technology requires disruptive investors. And my concern, and I can't see Mr. Bankman-Freed, is does this disrupt the markets as a whole? I honestly don't think it's necessarily bad if the majority of crypto is traded overseas. I just don't. Now, if corn markets and energy markets moved overseas, that would be a significant concern for me. But my question for you, Mr. Freed, is that, as I understand from your comments, FTX.com has been operating internationally, and you allow this model overseas. Is that correct?
Yes, that's correct.
So can a U.S. investor not operate on your platform overseas?
That is correct. They cannot. We have a separate platform for U.S. investors that does not currently have a margined futures product on the overseas application, which is licensed by a lot of the world today and overseen by many of the top financial regulators. We do offer a very similar product to what we are proposing here.
But a U.S.-based investors cannot transact through.
That's correct.
Okay, that was one of the questions that I had. But Mr. Edmonds, in your testimony, you expressed concern that the proposal, if approved, could ultimately be applied to traditional agriculture and energy markets. And that's one of my primary concerns. You also stated innovation cannot supersede the primary function of future markets for price discovery and hedging. And I agree with that statement. But can you elaborate on how you see this proposal potentially affecting markets and the farmers that I represent who use them, especially in today's day and time with fertilizer and other input costs as high as they are? I'm extremely concerned about this.
Yeah, I believe it raises the cost of their operation at the end of the day if you were to apply this model to those markets, because you're going to pre-fund. And today, when an FCM sits in the middle of the transaction and represents the end client to the exchange and clearinghouse, they have a very wide-ranging relationship with the end user at the end of the day. They're looking at much more than just an individual transaction. In the FTX model, as it's proposed in the application, it's an individual transaction, and when you're under equity, at that point, you face the liquidation that Mr. Duffy and others have commented on here.
Mr. Bankman-Freed, you have anything to add to that? I mean, the energy and the commodity markets are where my primary concern.
Yeah. So first of all, I completely acknowledge that this model would require further analysis for some asset classes before we would want to launch any products there. I believe the same would be true of what the CFTC would want. We are not planning to be launching energy products anytime soon with this model. We're going to be starting off just with digital assets because, as you say, when you look at assets that are not typically traded 24/7, assets that have physical settlement in physical warehouses, assets with different types of market participants, that does involve a further conversation.
But your application is not limited to margin digital commodities, is my understanding.
We are not intending to list them. I do not believe the CFTC would want us to list non-digital assets out of the gate. And
Then why
yeah.
why does your application allow for it?
That is how standard applications are. But if this is something that you don't trust the CFTC to exercise their discretion on, we could look into writing some time period during which we could not do that in our application. Like, that's the kind of thing that we would be open to. Like, I'm not lying to you right now. I really do mean this. And I trust that the CFTC will enforce that as well. But you could look into other controls on this.
You said time period. What about a permanent restriction?
Why would you think that there should be a permanent restriction? As I understand it, you're asking questions about the suitability, which I think are appropriate and would require further discussion. You could imagine something where it would require a further review by DCR in order to list them, which I think would be potentially appropriate.
My time's expired. I look forward to the roundtable, Mr. Chairman.
Thank you very much, Mr. Scott. And now the gentlewoman from Connecticut, excuse me, Ms. Hayes, who is also the chair of the Subcommittee on Nutrition, Oversight, and Department Operations, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. This is a very interesting topic for me. As an educator, I am always interested to learn new things, and as a legislator, I realize that we cannot put our head in the sand and not evolve as markets are evolving and our economies are changing. So this is something that we really need to have these thoughtful conversations about, and we need to be doing that right now, not after it's too late. The digital asset market is expanding. In fact, in my state last year, a firm was opened in Connecticut. So the cryptocurrency sector is emerging. Mr. Bankman-Freed, your proposal supports the idea of removing intermediaries as a means of democratizing the digital currency market. I'm concerned that removing intermediaries from the equation could create an opening for fraud and abuse, particularly towards new customers that are entering the digital asset market for the first time. While these assets could present a path towards building wealth for some, I'm concerned that the volatility of the market could lead to average customers losing even more, especially without proper oversight. So my question is, how do you respond to the assertion that the elimination of capital investment combined with your proposal to self-fund your guarantee fund will result in a lack of incentive for participants to mitigate their own risks?
Thank you for the question. I guess there's a few different answers, a few different things going on. To one of those, it's absolutely important that we still have protections against fraud, against scams, and some of those protections are often provided by intermediaries like FCMs. To the extent that they are, it is absolutely incumbent upon our platform to have those same protections. We do have those. That is a piece of our proposal, and the entire platform is under CFTC oversight, and they would be enforcing that would be true as well, that all of the necessary customer protections that typically exist were in there. Talking about the point that you've raised about the capital, in addition to the first line of defense being our own skin in the game rather than our customers or intermediary skins in the game, in our model, the initial margin for the positions is posted directly to the clearinghouse. And so in addition to that guarantee fund, there is a lot of capital which is held directly with CFTC oversight, segregated accounts, for margin for the customer's positions, which also provides a capital backstop for them and does not require trust on that side. I'll just last say that for institutions that do want to access it through intermediaries, as I imagine a number of them would, we're absolutely open and excited to work with FCMs on that front for them to fill a role as intermediary, especially for their existing clients and other clients who want their services, as many do. And that when you talk about extending credit, that is something that an FCM could come to an agreement with their clients.
Thank you. That's quite the optimistic viewpoint. Mr. Duffy, do you believe that this model would be secure enough for retail investors to build wealth? Or do you believe, conversely, that the increased market volatility caused by lack of backstops will endanger their investments?
You know, it's really difficult for me to predict what the retail investor will profit or not profit, because you've seen a lot of them make a lot of money. And I like to remind people that I've seen a lot of people make a lot of money being wrong to market, and I've seen a lot of people lose a lot of money being right to market. So it's all a question of timing. So it's really difficult to make that assertion. I am concerned about the overall proposal. Now, Mr. Bankman-Freed continuously says that he will not apply this to other products. That is absolutely irrational for him to have the ability to apply it to a single asset class while the rest of us sit on the goal line, while he's at the 50-yard line and he decides to deploy it in other asset classes and we don't get the ability to do it. There are a lot of problems with this, but from the educational knowledge that needs to go to the retail investor, I think has been completely underserved. CME Group has been an institutional participant for many, many decades now, and we continue to do it. But we do a lot of education with the retail investor. We don't believe in the app model with a credit card, sign up, and good luck to you. We don't think that's a process that makes a lot of sense for retail investors. I made reference earlier, there's a publicly traded entity called Coinbase. If you all may have noticed, these people are down 90% in value in 6 months. So they are all based off cryptocurrencies. So those participants are retail owners of that firm, not institutional.
Thank you. My time has expired, but I will be submitting an additional question for the record because we heard from Chairman Rostin Benham that they would need to expand their budget in the USDA to oversee cryptocurrency. I have some serious concerns about what that looks like, but I will submit those questions for the record. Thank you, Mr. Chair. I yield back.
The gentleman from Arkansas, Mr. Crawford, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here today. You know, kind of following on with what my colleague, Mr. Austin Scott, was discussing with regard to agriculture producers. I mean, this is the Ag Committee. So if we're not concerned about ag producers, you know, we're on the wrong committee. So I want to put it in the context of how this might potentially impact the ag markets, for example. I mean, the thing that I talk to farmers all the time. You plant wheat, you're long wheat. You got a position in the market, you're long wheat. There's an underlying fundamental to that. You plant cotton, you're long cotton. It's just how it is. I'm really struggling to understand, and in all earnestness, what is the underlying security of Bitcoin or any other cryptocurrency in the context of other commodities that make this, just as an example, one cryptocurrency in 24 hours, I think it was yesterday, lost 97% of their value in 24 hours. So I want to be forward-thinking. I want to be, a modern guy and try to understand crypto, but I'm really struggling with it. And my concern is that farmers are looking at this and go, oh, heck, if we were ever going to try to incentivize farmers to get in the market and avail themselves of this fundamental risk management tool that we call the commodities futures market, I don't see this as an incentive. That's my concern. Am I missing something here? I know that, Mr. Bankman-Freed, I know that the proposal is only limited to Bitcoin and Ethereum futures, and I get that, but I'm concerned about the precedent that we're setting here, and so I guess my question is, would approval of the proposal open the door for other exchanges to use this model for traditional futures contract, like I mentioned, cotton, corn, wheat, other ag commodities, and what would prevent broader application of this sort of proposal beyond the current intent?
The CFTC has oversight of all of the clearinghouses and exchanges, and would have oversight of any new risk model submissions and could deem those inappropriate if it believed that they were so. I think that if you have feedback to give to the CFTC that you think is important to give to them on what they should and should not deem appropriate, I suspect that they would probably welcome that. I don't see how that's relevant to our application. That is not what we're doing. But I do think that it would be appropriate to have a longer period of discussion on agricultural commodities and risk models prior to implementing any new models for them.
I got you. Mr. Duffy, I just indicated Terra as one example, a 97% loss in 24 hours, 25% Bitcoin down 25% in the last 30 days. Do these crypto market trends concern you with what we're discussing today, specifically as it pertains to market risk and asset volatility?
So let me make a couple of comments. First of all, Mr. Bankman-Freed has continually said that it would be up to the commission to do this, but in the same time, he has said to his body over and over again, he has not eliminated, when Mr. Scott pressed him, would he not deploy this model into other asset classes, which he would, and if he doesn't, others will, because it's a cheap model to do, because the oversight goes down. Secondly, on your first question about what's a cryptocurrency worth, if it goes down, it's worth zero. If corn goes to a certain price, you have an ear of corn. That's as simple as it comes. You have nothing when you have cryptocurrency goes to zero. The risk of this going into other markets is extremely detrimental. We have two countries fighting each other right now, and I thank the gentleman for his service at the end of the table. We have two countries fighting that have a third of the wheat production that's going to be off the market. Don't worry about other products. You better worry, the questions that need to be worried about, are we all going to be able to eat? And we need to have sound, prudent risk management. And I cannot be forced into a model, but I will have no choice to deploy if, in fact, the CFTC goes down this path, because I will deploy it, because somebody else will. I have a fiduciary obligation to my shareholders and my clients to do certain things, and I will have no choice. Otherwise, I will be out of business. This is a proposal that's fraught with danger, and I've outlined that in my testimony. The application that's been put forth to the CFTC is completely different than some of the comments that are being said at this panel today. So I can only comment on what's out there. He is not eliminated from other asset classes from his application, to be clear.
Thank you. Volatility seems to be a recurring theme, and my concern is that this volatility is exacerbated by inflation, and inflation is exacerbated by this market volatility. Is that a fair statement?
It is a fair statement to some, and others would disagree with you, but I happen to agree with you.
All right. Thank you. I yield back.
Thank you, Mr. Crawford. And now the gentlewoman from Ohio, Ms. Brown, is recognized for 5 minutes.
Thank you, Chairman Scott and Ranking Member Thompson, for holding this hearing today. And thank you to our panel today. We appreciate hearing from all of you. I believe that our country modernizes and evolves our financial institutions should also. Innovation and ingenuity when it comes to market access and clearinghouse models is something that I have been pleased to see that CFTC prioritized. However, this cannot be done at the expense of consumer protection. Mr. Bankman-Freed, how does FTX plan to strike the right balance between offering innovative financial products that may expand economic opportunities and eliminate barriers to entry for investors while still ensuring consumer protections are maintained?
Thank you for the question. We will have, in addition to all of the customer protections that exist on traditional models, on traditional futures exchanges, and intermediaries, additional suitability tests, transparency about the products, to ensure that customers are fully informed, fully aware of what they're doing, that they have an understanding of these assets and these products. We're going to be going through voluntary disclosures and analyses that will be made public of any assets that are listed on the platform, and make sure that those are obvious to users of the platform, in addition to the mechanics of the platform on it. I think that it is important to be able to offer equitable access to investors. As you said, that affords equitable opportunities to grow wealth. But I also think that it is important that people are extremely aware of what they are trading, of how it works, of its mechanics, that they are not accessing things that they do not at all understand, and that they are accessing products that have the liquidity to support the demands on it. So I think it's extremely important. We spent a lot of time on it, and if it's helpful, we're happy to follow up with you as well and send over what some of those materials that we have are on the transparency and disclosures and suitability.
Thank you. Because I consider consumer education to be a critical segment of consumer protection. So investors should have access to the necessary tools to make informed decisions about their financial wallet. Just to kind of expound on that point, Mr. Bankman-Freed, how does FTX ensure that customers have an appropriate understanding of derivatives trading before engaging in trades on the FTX platform?
Yeah, absolutely. So in addition to having, our entire rule book, all of the market data, and everything made publicly available, before you can access any trading on the platform, you have to go through a walkthrough of the FTX US derivatives platform that explains how every piece of it works, that explains the products you would be trading, and for smaller users, a test on that tests your knowledge of how those products work, to ensure that that there is, basically forced disclosure, transparency, and checks that people understand, the mechanics of the products and of the platform. Again, super happy to follow up. Happy to have a further discussion about this and show you the materials that we have on that.
Thank you. Same question to you, Mr. Perkins. How does Coinbase ensure that customers have an appropriate understanding of derivatives trading before engaging in trades on your platform?
Thank you, Congressman. I'm with CoinFund, and we do not provide access for customers. We're not an exchange. We are an investment management firm, so maybe I can follow up with you offline on that.
All right. Well, thank you, Mr. Chairman. With that, I yield back.
Thank you. And now the gentleman from North Carolina, Mr. DeRozier, is recognized for 5 minutes.
Thank you, Mr. Chairman. This is a very interesting subject. Pleased to have everybody here. Walt, great to see you again. Walt and I fought battles in a previous life as Senate staffers years ago, and really great to see you. Mr. Duffy, and I don't have any pre-bias with any of the questions that I have. I'm just trying to understand the situation a little better. But my understanding is the CME Group proposed its own direct clearing model in 2016. What problems were you hoping to address in the futures market at that time, and do those problems still exist today?
It's interesting because I think people believe that I am opposed to the direct clearing model. I've never said that I was opposed to a direct clearing model. I said I oppose the FTX's direct clearing model. So I want to make sure that we're crystal clear on that. The model that you're referring to in 2016, as you, I'm sure, are aware, the illustrious federal governments and Federal Reserves, central banks around the world, decided to come up with what's called the leverage ratio that made it extremely punitive for banks to participate, and their capital balance sheets were being consumed by the leverage ratio under Basel III. So what we were trying to help accomplish was to get clients to be on CME's books directly, but still have to adhere to all the rules and procedures and protocols of the Futures Commission merchants at the same time. We eliminated that program for a couple of reasons. One, the CFTC asked me to, for starters. That's who told me to get rid of the program. Secondly, we got rid of it because they changed the leverage ratio on Basel III, which made some of the banks a little bit more compelling to do customer business. But it was a very punitive time in the leverage ratio, if you recall, back in that time period of 2016. That's the reason why we abandoned the direct participant model. I'm not opposed to it, sir. I'm opposed to this application for a lot of reasons, because it does not conform to the existing Commodity Exchange Act of 2000.
Understand.
Thank you.
Mr. Bankman-Freed, and you may have touched on this earlier and I just missed it, but what has been the experience in other countries? How many other countries have authorized?
Yeah. We are working with regulators in a large number of countries across the globe. On our platform, we are licensed and regulated in a number of them, including Japan, Switzerland, European Union, Australia, and others. We've had productive conversations with a number of them. And, I think that they have, I'll obviously let them speak for themselves, but, they've become comfortable with the model as it operates. The model that we would be proposing for FTX US derivatives is a more conservative model than what we operate overseas. I think that it has provided a large number of helpful risk features and safeguards on the product. We comply with anti-money laundering, know your customer standards globally, and are helpful wherever we can with regulators and law enforcement. So, I look forward to working with the CFTC to continue to dive into our application and ultimately come to the judgment that they think is appropriate.
Mr. Lukin, do you believe that your members might find it attractive to participate in an exchange that does not charge for data, connectivity, or to require contributions to the Clearinghouse Guarantee Fund?
Yes. I think FCMs over the years have indicated that a certain amount of regulatory data is necessary for the risk management functions that they provide. So getting access to that data in cost-effective ways is very important for the downstream market users of that data. So that is certainly an innovative thing that FTX is doing, as well as an appropriate amount of skin in the game in the capital fund, the default fund.
Do you think two exchanges controlling 97% of U.S. futures trading volumes is a competitive market?
Is that to me? We would love to see more competition. I mean, that's really, but this is a scaled business. We understand that. It's a volume business, and so the DNA of our industry is that liquidity comes to a few exchanges, but we're always looking for new exchanges to compete globally and make sure that everybody is checked in the system and make sure that prices are fair and products are offered.
Yeah, I guess my only final comment in the last 15 seconds is I think crypto is here to stay. I think America needs to be on the forefront of it. A number of us are quite concerned about our debt as it relates to, or at least I'm very concerned about the debt as it relates to our ability to keep the dollar as the reserve currency of the world. So I do think that moving forward we have to be very thoughtful about this subject area because I think it's got real long-term implications. Mr. Chairman, I yield back.
Thank you. Now the gentlewoman from New Hampshire, Miss Custer, is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate the opportunity to have this conversation, and I agree with my colleague that crypto is likely here to stay, but it's very complex, and we all need to have a good understanding of it. The Commodities Future Trading Commission is weighing this FTX application, and I think it's important for Congress and the public to understand the context here as fully as possible. And Mr. Chairman, I would like to enter for the record an article in today's Forbes and in many media organizations. The title is $1 trillion Crypto Meltdown, Huge Crash Wipes Out the Price of Bitcoin, and it goes through all the rest. So obviously there's some volatility here that we need to understand, and I appreciate the witnesses being here to walk us through it.
Yes, so ordered.
Thank you. It's clearly that it's a growing financial field and important to have for American consumers to have access and to understand the crypto marketplace, but also the level of risk that they can expect when trading. In my lifetime, I've never read of a $1 trillion meltdown. So FTX's application has obviously generated a lot of discussion. As evidence, not only the views we've heard by our witnesses today, but the extraordinary number of public comments that CFTC received about it. So the factor of the application that I want to focus on first and foremost for my constituents involves taking intermediaries out of this clearinghouse model. I know there are certainly some exceptions, but historically, intermediary stakeholders have played roles in derivative markets by vetting traders, assuming some risk, and shoring up the clearinghouse itself in an event where the clearinghouse long-term viability is in jeopardy. Mr. Duffy, from CME's perspective, do you believe that all moves toward disintermediation in derivatives organizations create risks similar to those you noted in your testimony regarding FTX proposal?
I think I understood your question, ma'am, but I think I didn't hear it completely. So do I believe what? I'm sorry.
That all moves toward disintermediation in derivatives create risks similar to those you noted in your testimony regarding the FTX proposal.
No, I mean, here, I think when you look at the FTX proposal basis, what we deploy today, the disintermediation model that you referred to is a concern. I said I was a favor in not opposed to the direct model, But at the same time, I'm not wanting to lead the charge on disintermediation. I do believe when you look at margin today, CME has a certain margin that we charge, but what's really important is the firms that Mr. Walt Lukin represents also puts a surcharge on top of that, which you would not have in the disintermediated model. So meaning if I charge $1 for margin, that clearing firm might charge an extra 2 or 3 to its client, which gives them the ability to manage their risk. So that's one of the huge benefits of having the model that we have. So I'm not leading the charge against disintermediation. I don't think it's appropriate, but at the same time, I have to be prepared to move our firm forward. So we are looking at innovative ways, no different than Mr. Bankman-Freed and the rest of the industry is. I do not want to lead the charge towards disintermediation, though.
Okay, thank you. So turning to Mr. Bankman-Freed, could you elaborate on what considerations were front of mind as FTX was developing this non-intermediated model, and if any alternative structures were considered specifically to protect consumers from the risk of a $1 trillion crash?
Thank you for the question. I will note that stock markets have probably lost more than $1 trillion over the last few days as well. But it's been a brutal month for markets. A few notes on this. We did consider a number of different models. This has a lot of similarity to the models that are used in every other country today for cryptocurrency futures exchanges. This is how hundreds of billions of dollars of volume are processed on a daily basis. It has withstood large market moves, including over the last few days. That being said, there are advantages to an intermediated model. There absolutely are. To give one clear example of this, if you have a trading firm that is using a prime brokerage service through which much of their flow goes and their assets are held, and they very well might want to send their FTX orders through that as well, we absolutely welcome that. We welcome them going through that FCM. And more generally, when people talk about, well, you could have, FCMs are requiring additional margin, there's a credit relationship with their customers, they can absolutely do that in our model as well. We require that the clearinghouse has capital posted to it, but the intermediaries and FCMs are absolutely welcome to have bespoke arrangements with their clients where they request additional margin in order to buffer positions, where they can give credit to customers if they trust those customers and that collateral is deposited, whichever system works best for them and for their clients.
Thank you, and my time is up. I yield back.
The gentleman from Illinois, Mr. Davis, is now recognized for 5 minutes.
Thank you, Chairman Scott and Ranking Member Thompson, for holding this hearing. While this committee, I believe, is still not addressing the impact that 40-year high inflation rates are having on ag inputs, gas prices, and grocery bills, maybe because inflation rates are down a whopping 0.2% this month. But I'm glad we're having this discussion, really given the impact that this issue is going to have on ag commodities. There's a lot of attention and engagement in the cryptocurrency market. It's not the role of Congress to pick winners and losers, tell people what they should or shouldn't invest in, what platform investors should use, or the tools and technologies companies should seek to adopt. Right now, we're talking about clearing cryptocurrency derivatives. But in my opinion, there's no real distinction between the clearing of ag commodities and cryptocurrency in terms of the risk management standards that we currently have on the books. My concern here is with the impact on futures market stability and the risk management of volatility in ag commodity prices for everything from corn to soy to energy and natural gas. The farmers in my district, they're not mining Bitcoin in their spare time, and it's not because they're worried about climate change. And yet this issue before the CFTC could potentially affect them in the same way, and the same as crypto traders. The major concern I have is that the CFTC, they have the ability to create a de facto regulatory structure via piecemealed applications that do not lend to clear guidelines or a level playing field for all market participants and stakeholders. Financial services regulations in this country overall are extremely complex. And as a Republican, I actually find many of them to be overreaching and unnecessary. But the fact that a politically appointed commission or even its staff can set singular market standards for one company that impact an entire market is somewhat astonishing. This is not how far-reaching market structure changes should be made in this, or frankly, any other financial market. If you look at crypto prices right now, the last thing our farmers can afford to see today is a new layer of volatility that stems from one-off CFTC decisions. And I agree, market volatility has been across the board. These potential changes in risk management practices and therefore their impact on volatility, I fear, could become a reflection of a piecemeal regulatory framework and not a thoughtful, consensus-driven approach. I'm really not here to bash a company or an idea. But I do think that the Commission needs to act with caution and go through a proper rulemaking process to ensure fairness and clear rules for all market participants and those potentially impacted. So my question is this, and I'll start with Terry. Would you like to respond to that?
To your statement, sir,
Your statement.
I agree with your statement wholeheartedly. I am very concerned that the Commission is unilaterally looking to make a proposal for a single asset class. And if, in fact, they do that, they would have to amend the application that is put forth already today by every legal mind in the world. And once that application is amended, it is open to all asset classes. So otherwise, it's deemed arbitrary, and the Commission cannot be arbitrary, and Mr. Lukin knows this as well as anybody. So we would have no other choice, because this model, as I said earlier, is a cheap way around jurisdiction, and we would have to compete in it. Otherwise, I'm going to have either FTX or somebody else competing in the asset classes that I'm trying to provide liquidity and risk management for across the board. And that includes every single commodity known to man: wheat, corn, soybeans, right across the board, energy, natural gas, mortgages, foreign exchange, equity futures, everything.
Which affects my farmers in my district.
It will
and their
affect
ability to get
every
their
farmer,
products.
because they will have to be up, as Mr. Edmonds said earlier in his testimony, at 1 o'clock in the morning on a Saturday, finding out that they just lost their hedge on their crop that they already have in the ground. Why? Because they got auto-liquidated.
Sam, it was great meeting with you yesterday. Obviously, as we mentioned, I have some concerns about the issue that we're discussing today. Can you tell me, based upon your testimony earlier, what kind of impact do you think the proposal that you've put forth and your team has put forth could have on my farmers? Can you help me understand my concerns about the impact of the ag commodity industry?
Yeah, thank you for the question. Unlike Mr. Duffy, I would consider whether it was an appropriate risk model before deploying it, and would only do that if I thought it was healthy for markets. I do think that this is healthy for markets, at least in digital assets. That is why we've put it forward. I think it is a more conservative risk model that is non-recourse with respect to the participants, that requires that the collateral is submitted to the clearinghouse and is definitely there beforehand with clear and transparent guidelines and rules around the risk engine. And I think that all of those can help decrease volatility and increase liquidity in markets. All of that being said, I will reiterate that I am not planning to launch this in agricultural markets anytime soon. Doing so would require further DCR review of any new risk.
The gentleman's time has expired. Thank you
Walt.
very much.
Thanks, Chair.
And now I recognize the gentleman from New York, Mr. Maloney.
Well, thank you,
You're
Mr.
recognized for 5 minutes.
Thank you, Mr. Chairman. What a fantastic hearing. Really commend you for holding it, for the ranking member, and for the diverse views represented here. Well, first, I feel like I should have made better career choices. But second, I have to tell you, Mr. Bankman-Freed, I'm fascinated by this. I think it's a really interesting idea. You sure got everybody stirred up. And they hate it. They hate this idea. I mean, understandably, because of what it might do to their businesses, but they're also concerned about whether it blows up their business model or just the world economy, and that's where we come in, I think. So, I mean, clearing disintermediated margin derivative trades directly to retail customers. That's a subject comes up a lot at my town hall meetings. and dynamically setting margin levels and auto liquidation and transparent models. I mean, it's actually a really cool idea. So I really commend you on it, and I really want to understand it more. And I am completely agnostic about it. Help me understand the auto liquidation point that Mr. Duffy's making.
Yeah, so I can tell you how I see it. Obviously, different people have different viewpoints on it. But the way I see it, you have some user that's put on a position. There is some collateral for that position. In our case, it is held transparently with the clearinghouse. At some point, if markets moved far enough against that position, they would be out of collateral. And at that point, the position, in our model, has to be closed down. Because otherwise they would be more than out of collateral. Their account would be net negative. There are a few options for what you could do there with different risk models. One thing that you could do is have a recourse-based risk model where you let them keep the position open and then go after their house. If it gets negative enough, that is not what we intend to do. We intend to instead deleverage the positions if they're out of collateral. But on the point of the speed and of the risk engine, right, of whether you're liquidating quickly or whether you're waiting a few days. If you wait a few days to do it, you have a choice between either beginning a margin call and liquidation way earlier than may be necessary in case markets move against that position over the next few days, or waiting until a position is almost underwater and might be way beyond bankrupt by the time you could finish that liquidation, leading to scenarios like what we saw with LME.
Yeah.
The advantage of the real-time one is that you can actually precisely measure where a position is, wait to liquidate until the last moment so that you preserve the positions if at all possible, while still protecting against systemic risk.
I want to let Mr. Duff get in here, but also want to talk about your models. How do we know you have the right models? How do we know you have the right risk models? What if you get your models wrong?
So,
because if you get your models wrong, it's all wrong.
Yep.
All right.
Absolutely. So there are a number of things. We've gone through an extensive process with the CFTC on this, on the details of the model, on the back testing of it, both the historical data with simulated data, under all of the necessary standards. In addition to that, we have been running a model that this would be more conservative than internationally for the last 3 years. It has gone through days with 40% moves in markets in a single day. We just went through a 40% move over a few days. It has been functioning well in that environment, handling tens of billions of dollars of daily volume. We've never had to mutualize losses. We have never gotten close to that point. The entire insurance fund draw over the history is a tiny fraction of what we're proposing for our own skin in the game for the initial guarantee fund. And so that's sort of an empirical test on it as well.
All right, 50 seconds left. Mr. Duffy, I know you hate it. And I know you said you're not against it, you just don't lead the charge, but it's a hell of a disruption, let's face it. And it doesn't mean you're wrong. Help me understand. I mean, so are you saying no? Are you saying not now? I mean, Mr. Lukin's statement was exquisitely worded. He just doesn't want to do anything right now, wants to look at it more. Very thoughtful, tough debate. What do you think?
I believe that there should be a formal rulemaking process at the Commodity Futures Trading Commission where everybody gets to participate in that process, and do not make this just about crypto. Make it about market structure. That's what I'm here to discuss. And on that proposal of auto liquidation, so one of the things that FTX does not tell you, or this committee, is what they do for collateral. When I take on collateral, whatever form it may be, cash, treasuries, gold, whatever I have a mix of, we have to haircut that at a certain value. Their haircut on their collateral for Bitcoin is 5%. Their margin to trade Bitcoin is 15% of margin. This auto liquidator will be going with smoke coming out of it at those price levels. That is the problem with this application, and you need to hear the whole truth about this.
The gentleman's time has expired. Thank you. And now the gentleman from Kansas, Mr. Mann, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Appreciate Mr. Maloney's comments and questions. Also would like to associate myself with Congressman Davis' comments and questions, and really getting at the heart of, what will the impact of this, if it goes through, be on production agriculture, on the agriculture markets as we know them, and obviously a whole host of other issues. First question would be for you, Mr. Bankman-Fried. What is the difference, when we talk about market structures, what's the difference between the FTX proposal and the ICE NGX model that currently exists?
Thank you for the question. And as you're pointing out, there exists a number of licensed futures exchanges with the CFTC that have various properties of our proposal already, ICE NGX being one of these. The difference we have, we're combining together a few different things, each of which is found in other exchanges, but not always together. One of which is collateral held with the Clearinghouse, the real-time margining system, and the option for disintermediated direct access to the platform for all participants put together is, to the extent there's something novel, I guess that's what it is.
Okay. And the second question will be for you as well. There's been a lot of discussion, of course, and we just elaborate on a little bit on whether or not your $250 million guarantee fund is sufficient relative to the billions of dollars maintained by CME and ICE in their guarantee funds. Could you please elaborate on why you believe that your holdings would be sufficient relative to the risk in the market?
Yeah, thank you for the question. So first of all, and there are different terms used by the different models for similar things, which makes it a little bit confusing. I probably haven't done a perfect job of describing all this. In addition to the $250 million that we have put in the guarantee fund, that's our own skin in the game, none of that's mutualized. We also require margin held with the clearinghouse from all open positions. And so internationally, we have tens of billions of dollars of collateral in the equivalent of the clearinghouse today, collateralizing customer positions on the venue. And so that is a very significant piece of it that plays the role of collateral held at various intermediaries to some extent in other models, and is backstopping customer positions. I'll also say that we have done an extensive analysis historically of this model internationally. Total historical insurance fund draw was only a few % of the guarantee fund that we are proposing, and that's over the last 3 years combined, and that is with a less conservative model than what we would be proposing. So it has functioned successfully. I'd like to also just tack on one thing. The numbers that Mr. Duffy quoted are not necessarily numbers for the US platform. That was for the international platform. Although I will also note that empirically it seems to have worked. So I don't know where that smoke's ending up, but apparently it has been successfully managed, as I would predict it would be, given the parameters in the risk model.
Okay, thank you. A question for you, Mr. Duffy. You've raised concerns about the volatility and market disruption spilling over from a direct access market into the traditional market.
Yep.
Can you elaborate on how you see that risk transferring?
Well, and I've said it several times in my testimony in my hearing. Here's the way it's going to play out. Again, it's a market structure change when you go to a direct model that FTX's proposal is asking for. When that's deployed against other asset classes, the participants are not crypto participants. They're farmers, ranchers. They're producing oil, they're writing mortgages, every of the products that I trade. So I've been through that. They are not prepared, in my opinion, for this type of model today, because the auto liquidator that is being proposed is something that will be unsuspecting to the client. Now, he can talk about the margin that he has and the collateral that he has, but the bottom line is people at my institution, as I've said, have margin from CME, then they have additional margin from their clearing firms. So those clearing firms are in touch with their clients. And if, in fact, they touch certain levels, they get calls, and they determine either put up more money or we're going to take you out of the market. So an auto liquidator is not revolutionary new technology by any stretch of the imagination. But the way they do it is differently. But when you deploy that and you have to keep these markets open 24 hours a day, 7 days a week, against agribusinesses and others, I think it could be extremely detrimental in a time where, not only the time that we're living in now, but going forward for the food industry going forward. They need risk management tools. They don't need casinos to do risk management.
Great. Thank you. With that, my time's expiring. I yield back.
The gentleman from Arizona, Mr. O'Halloran, is now recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, for organizing this important meeting. Thank you to the panel. To be open, I am a former member of the Chicago Board of Trade and their Board of Directors, so I have a little bit of background in this subject. I understand the importance of innovating and updating our marketplaces It's extremely important, and it's happened over time. I also understand that what I've heard here today is issues that impact consumers. It impacts the marketplace in general, the ability to hedge risk, the taxpayer, and the economy in general. And this type of a change, I think, is important to look into in a way that includes everybody that should be at the table. I am awful upset with the idea that we're even referring to the words skin in the game. This is no game. This is about the economy of America, and we've seen too many issues over time. I also have a message for the CFTC. They need to work on this with us on an ongoing basis. Not a little bit of a time, not a surprise. Don't even come to us, I don't think, before you talk to the community in general that's involved in this on an ongoing basis. So, however, I am also aware of the risks that can appear if we approach these changes thoughtlessly. And so that is my opening statement. And while on the board, I saw markets crash. I watched firsthand as the clearinghouses provided stopgaps to protect consumers. It's a model that has worked over time and keep losses to a minimum. And there is no way in this marketplace that we're going to see a new model come forward. And if it's going to work in the process and people are going to start to push for that model, it'll expand. That's all that's to it. There's no ifs, ands, or buts. After looking at the FTX proposal, I wonder if a shift towards an all-in-one approach can offer these same protections. I appreciate the CFTC's deliberate and public approach to answering this question, as this decision will likely set precedent for future regulation. But we have to be very thoughtful going into this, and I think this is a process that has begun way too late and has not spent enough time at the process. Mr. Lukin, in your testimony, you note that the FTX proposal would replace the traditional distributed risk clearing model with a more automated and centralized model, absence of intermediation. Will collapsing the functions of various market participants into a centralized entity create potential conflicts of interest that may impact key risk management functions?
That's our concern. I think, traditionally we have put certain responsibilities in different entities. The FCM is overseeing the client, the clearinghouse is overseeing the FCM and the client's money there, and the regulator is overseeing everything. When you start to integrate that, there are conflicts of interest that arise, making sure that customers, when they're liquidated, you're trying to hold them whole as best you can when doing so, and not making impacts on markets. So when you start to combine things, I think we have to be very thoughtful about conflicts of interest and how that's managed.
Thank you. Mr. Duffy, one way the FTX plan accounts for risk management is through auto liquidation. I've heard a little bit of discussion about that today. Can you please explain how you see this process functioning from your perspective? And the digital assets are known for being volatile, highly volatile. Do you fear this new structure may lead to a greater number of liquidations?
Again, I'm always cautious about trying to predict the direction of a market. I think that's really difficult to do. My job is to manage risk of market participants and make sure both sides, the pays and collects, are done properly. And that's exactly what we do at our clearinghouse, as you know, sir. I've been in this business for 42 years, and I've seen a lot of things. And when we look at risk management, I think what's really important is that CME has never, in the history of its company, ever had to draw on its guarantee fund to cover losses. So I'm referring to the '87 crash. I'm referring to the meltdown of 2000, things that we've all seen. I'm not referring to the last 36 months where the market went straight up in crypto and it hasn't had a loss. So I think there's a bit of a difference here. I am very concerned that when you put new proposals forward, they are interesting, but they need to have the input of all participants, not just one particular segment.
Thank you, Mr. Chairman, and thank you, Mr. Duffy, and I yield.
Thank you. And
Now, the gentle lady from Minnesota, Mrs. Fishback, is now recognized for 5 minutes.
Thank you, Mr. Chair. And thank you all for being here. I appreciate the opportunity to ask a couple of questions. But I do want to, I know that Mr. Davis had started a little bit talking about ag and ag markets, and so I did want to ask, obviously the ag market is facing incredibly difficult times right now. Inflation is hitting them, and risk management tools are even more important than ever. But Mr. Lukin, you know that farmers and agriculture community are core users of the derivatives market. Why are these markets so important to that community, and what tools in the existing market help this community manage the risk?
Well, farmers deal with incredibly thin margins, as you know. So our markets are ways that they can manage risk. They're planting in the spring and harvesting in the fall. In that time period, you don't know what the price of corn may be when you harvest. So our markets are there for your constituents to make sure they can manage that risk appropriately. And they have lots of other things they must worry about. They don't want to have to worry about the price of corn or wheat up in Minnesota. So these markets are incredibly important, and that's why I think today's discussion is important, because this is a precedent-setting event.
And do you have anything else that you just add about maybe how the proposal? I know that Mr. Bankman-Freed said that it doesn't deal with the ag markets right now, but do you have anything to add about potential issues with the ag market or?
Well, I mean, the proposal as before the CFTC is open to any asset class. This is really not about cryptocurrencies. This is, as Mr. Duffy was talking about, market structure. Futures markets are a well-regulated, best-in-class regulatory system that this committee helped to construct. And so if we're pivoting from that, that's going to have impacts beyond simply cryptocurrencies. So we want to be thoughtful about this. We want to be deliberative about this and make sure the rules of the road are the same and at the highest levels of risk management. So it does have the potential to impact ag markets. Again, they need access to risk markets, and we want to make sure it's fair and safe for them.
Thank you very much. And Mr. Bankman-Freed, do you have any response to the issues with the ag market? And like I said, I know earlier you mentioned that it didn't involve that, but curious as to your reaction.
And again, just reiterating again, we're not planning to get into ag anytime soon, and we are open to making that legally binding in some ways, to making that formal. I think that I would be really interested in doing a deeper dive with the community, with the constituents, on risk models in the ag markets. I think there are parts of this risk model that I think could be helpful and appropriate. There are also things that would need some deeper thought around weekends, around physical delivery, and how that would interplay with the risk engine. And so I think that, I basically still think that some properties of this may end up being very helpful and attractive for those markets when you look at the easy, equitable access, when you look at the clear, transparent margining, and when you look at not making our farmers pay for market data that's supposed to be providing public price discovery. But I would also, welcome a longer process around ag products.
Thank you. And Mr. Duffy, I have to call on you because you are making faces. So looked like. So did you have a response? You looked like you were ready to say something.
Well,
Maybe
I'm always ready to
making
say something.
faces,
It's in my nature. I can't help myself.
Okay.
First of all, on the market data question that Mr. Bankman-Freed continually says how it's free, we never charged for market data historically at CME Group. We never did till just a few years back. The reason why we charge for market data, it's just not your data and you're paying for it. You're paying for a constructed amount of data that has a tremendous amount of value that I have to put a lot of effort in and cost into accumulating that data for people to buy to do their risk management, whether it's historical data, whether it's derived data or other data. It's not just market data on pricing. So it's really important to make that distinction about this free data that he keeps referring to. We sell quality data that brings benefits to the participants, but it cost us a lot of money to do it. The model that's going to potentially be deployed, Mr. Bankman-Freed keeps reminding everybody that he does not have any intention right now to go into other products. He has the ability to do so. His application says he can do it. So I am supposed to sit on a sideline while they decide if they're going to do it or not, and they'll be way ahead of me because they're doing it in a crypto asset class. So what will happen is they'll do it. The ag community will go with him when times are stable. When they hit the fan, they're going to want to come with me. I'm not going to be there because I'll be deploying the same model. This is a nightmare for the agricultural community.
Thank you, Mr. Duffy, and I got 6 seconds, and I will yield all of those 6 seconds back. Thank you.
Thank you very much. And now the gentleman from California, Mr. Kahana, is recognized for 5 minutes.
Thank you, Mr. Chair. Thank you for your leadership. Thank you to Ranking Member Thompson for his leadership. Mr. Duffy, you obviously have very strong opinions about cryptocurrency, so let's start with the basics. Could you tell the committee what you understand and how you define blockchain? And can you tell us some of the use cases of cryptocurrency for the American public?
Yeah, you know, I had a conversation with somebody in the industry, and I believe that the use case of cryptocurrency.
If you could start with the definition of blockchain. How do you understand blockchain?
The blockchain is a node, either centralized or decentralized, run by different platforms with parts of information that only certain people that have access to it can change that information. And once it's in the blockchain, it stays there. And in order to amend the information, it's a lot of procedures and protocols to go through the blockchain. It's a very complicated procedure. I think it's an excellent form of commerce for medical records, things of that nature. So I do think.
And what do you see as some of the use cases?
Use cases of blockchain?
Yeah, and cryptocurrencies and some of the.
Well, I don't know if there's a use case of here. The one blockchain that's been talked about today is Ethereum.
Do you see a use case for stable coins?
Do I think there's a use case? I'm happy to answer your question, but which one do you want me to answer?
Stable coins, yes or no? Do you think there's a use case?
Do I think there's a use case for stablecoins? I think there was until the other day. That didn't go so well for stablecoins, so I'm not so sure if there's a use case for them. I do believe central governments
You don't
around
think there's a use case for stablecoins? Okay, do you think there's a use case for Solana?
I think the United States government, sir, needs to be involved, and central banks around the world
I'm just
need to be
asking
involved.
you, do you think there's a use case for Solana or some of the other, of the top 10 cryptocurrencies?
I'm not a
do you think-
crypto expert, sir. I list Bitcoin and Ether.
Well, you certainly have opinions about cryptocurrency.
I do. I have
You're
opinions about an
testifying-
application, sir, not about cryptocurrency.
Now, you talk about here under
Pardon me?
oath, you say, if I could just quote you, because you may want to take this back, I don't know.
I don't take
You say
anything
the
back.
FTX, well, you're under oath, sir.
I'm not
FTX
under
has
oath,
no
I understand.
FTX has no capital requirements for participants. Is that really, are you going to stick to that under oath? Because the CFTC's Part 39 regulation requires capital requirements for FTX or for any of these exchanges. Are you really saying they have zero capital requirements, or do you want to amend that statement given
You
you're
know,
under oath?
sir, you're moving away from your microphone. Can you read the statement that you'd like me to?
Yeah, I'm asking you, sir, you have a saying so that FTX has, quote, no capital requirements for participants. I think that's on its face a false statement, given that the CFTC Part 39 regulation requires capital requirements, and FTX does have a capital requirement for margins.
I said their capital requirements are not the same as they are for other institutions.
Well,
I
that's
said,
not what you said, sir. Under oath, you have submitted to this committee a statement that is false. You have said the regime has no capital requirements for participants. I would strongly recommend that you have someone on your team amend
well, I'd like to read that statement because I happen to disagree with you, sir.
Well, it's your testimony. It's your
No, I get it.
testimony.
I'd like to see the statement that you are referring
Yeah, I'm
to.
reading
I
from-
can't just
you
go
don't
off
know
of what
your
you're
own
reading.
Testimony? You're
Capital
giving
is
false testimony.
not the same as margin, Congressman.
Well, sir, I want you to, after this, submit something that is accurate, recognizing you're giving testimony to the United States Congress. You don't know much about cryptocurrencies. You're opining on cryptocurrencies, and then you're giving false statements to the Congress that you aren't even staying. You weren't even knowing that you're submitting. You write FTX, quote, has no capital requirements for participants. That's just false.
Sir, I'll be happy to read my testimony back to you if you would like, but if you want to make this into a court of law, I'm happy to participate in that as
Well,
well.
it's not a court of law. It's that you can't go give false statements to the United States Congress. You
I'm
can't
well
come in
aware,
and
sir. I've
say-
testified in front of this committee over 50 times. I'm well aware of the procedures of this committee.
Well, then can you, I would submit that you need to correct the record because you have, quote, your testimony, no capital requirements for participants. That anyone who has basic understanding of the CFTC knows that Part 39 would make that a completely wrong statement. Of course, there are capital requirements, and I suggest in the future that you do some homework on what cryptocurrencies
Well,
are.
I
and
appreciate you telling me to do my homework. I
testify.
assure you, sir, in the amount of years I've been in this business, I forgot more than most people ever know.
Well, I appreciate it. I hope you will correct the record so you're accurate and not giving false testimony.
I don't give false testimony, sir. It's not what I do.
I yield back my time.
The gentleman from Indiana, Mr. Baird, is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, for holding this session. And, you know, I always appreciate the effort that the witnesses make and the testimony that you give. To have such expertise before this committee is extremely valuable to us, and I think it's valuable to whatever issue we're discussing. But I'm going to change just a little bit and ask this question, and I hope I can get each one of you's response. And so to do that, I better quit talking and start asking, I guess. The U.S. lags behind other countries in the adoption of digital assets, with over 95% of the trading volumes occurring overseas, and I know you know that. So my question is, like some of my predecessors, but how would this benefit Americans, including farmers and ranchers, if more of this trading activity were to be onshored and take place in the United States? I think that's kind of the core of what we're trying to do here too. So I guess I'm going to start. I want to do this in a specific order. Mr. Lukin, would you mind to start this discussion?
No, I do think there's been an identified gap of regulation by many that cryptocurrencies need to have. We need to develop a framework in the United States to do that. I think it's a reality that they're here to stay. I think it'd be in our interest as a nation to try to develop a strong regulatory system for cryptocurrencies to attract that to the United States.
Great. So then I want to go to Mr. Edmonds. Since you're involved internationally, I would like to know your opinion of how that affects that market.
Well, right now, I believe that the delta that exists in the world is we don't know what regulator is responsible for what version of a crypto asset, for the lack of a better term. You have the SEC expressing a desire to regulate parts of it. They'll call those securities. You have the CFTC that'll regulate part of it based on their charter. You have the United States Treasury who've made comments about that, about the oversight they need to have. You have the Federal Reserve System exercising comments or providing comments around what they should do when it comes to stablecoin. So right now, there's not a clear, known path that we can all sit back and make relative rational commercial decisions at that moment in time to say, these are how we're going to offer services if we so choose to do so. And so until that is settled, it seems very difficult of how you're going to regulate a market. And I think what FTX and others may be doing at the time is finding the closest thing they can get, because there still lacks a very consistent national message.
Thank you. And, you know, the next one goes to Mr. Perkins. And as a Vietnam veteran, I'll always let the Marines go in first. So, you know, they...
Semper Fi, sir.
I would appreciate your opinion about bringing it onshore.
Absolutely. Web3 is here, and we can't put the genie back in the bottle. And what we do, we owe it to U.S. persons to have a very robust, regulated, thoughtful derivatives regime that allows them to hedge their risk. My belief is that what FTX has proposed is viable and needs to be considered because it addresses a few things. It addresses thoughtful risk management and what we call defaulter pays. So the people that are putting risk into the system are paying for that risk via collateral. It's more inclusionary. I ran an FCM, and it was very difficult for us to give capacity to anyone other than our top clients. And so what I would like to see here is to give the ability for market participants to hedge their risk. You know, we talk about volatile markets. Right now, we haven't given these market participants the ability to hedge because the activity is offshore. And that's how I'd answer it, sir.
Thank you very much. And so then, Mr. Bankman-Freed, would you care to comment about that same issue?
Yeah, thank you. I completely agree. You know, almost all of the activity is offshore. I think that does not do a service to our country. I think that means that the traders in our country do not have federal oversight of cryptocurrency markets. It means they don't have access to the same level of liquidity, depth of order book, or hedging that users in the European Union, in Japan, in Australia, and a number of other jurisdictions do today. It means that we don't have that economic impact here. We don't have those jobs here. And I think that it would serve a lot of interests at once to regulate these in the United States. And that's what we would love to be a part of doing.
Thank you. Mr. Duffy, we've got about 25 seconds, so you got key words.
On the business being overseas versus the U.S.?
Yes.
Listen, I think markets are global in nature. They have a tendency to go to certain jurisdictions. Certain products do. Certain products are very domestic to the United States. Other products are domestic to the European Union, and others are to the Asian communities. So if cryptocurrency needs to be a global product, I'm not so sure that's the case. I think when you look at who's participating in the crypto business today, someone made reference that 1 in 5 people have traded crypto. I truly believe that's mostly retail participants that have been in this market, not institutional participants managing risk.
Thank you. I
The
appreciate all of
gentleman's
you. I yield back.
time has expired. The gentlewoman from Washington, Mrs. Schreier, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and welcome to our witnesses. Look, my biggest priority here is making sure that consumers and my constituents have options for investing safely. And even the most discerning consumers can face challenges navigating potential tricks and pitfalls when making a financial trade. And so I think it needs to be really clear that all derivatives clearing organizations are abiding by the Commodity Exchange Act, which regulates commodity markets. And I'm really grateful that the CFTC is taking such a thoughtful and diligent approach to considering all the different facets of this new proposal to keep your markets fair and safe. I want to make sure we're doing the same thing here on the Agriculture Committee. And so, Mr. Bankman-Freed, it's good to see you again. Can you tell me how does FTX plan to strike that right balance between offering new financial products that may expand economic opportunities for investors while still ensuring consumer protections are maintained?
Thank you for the question, and great to see you as well. I think that is the central balance to strike here. It is extremely important. And on the one hand, we want to be able to offer equitable access to the platform, to the data, so that consumers have that same fair level playing field as the largest trading firms do. On the other hand, we have to have all of the customer protections that we're used to in financial markets here. So, every piece of this is overseen directly by the CFTC in our proposal, and they would have oversight over it. We would be giving full transparency and disclosures about the products that we're listing, about the mechanics of the exchange, of the venue, about how it works, educational material about it, tutorials that you have to go through before using it, quizzes about how the product works, along with full explanatory material on it. And we are also looking to create sort of template registration type statements for the assets that we are thinking of listing, so that there is a lot of transparency and data around the products that people would be trading, and that we should only be listing things that are suitable for access here. And so that means working with the CFTC on that topic as well. These are just really, really important topics.
I want to thank you for listing off all of those elements, because when I hear the words, just as a consumer, myself, when I hear the words transparency and a list of all the risks, what I think of it is a lot of really small print that is really hard to understand and to read through and to really grasp the concepts. And so I appreciate your talking about things like big print, common language, information sheets, and even quizzes to make sure people really understand what their risks are. Do you have any information about those quizzes, or whether they paint even pictures of things gone sideways so people really understand risk in terms of a story? We find stories work well.
Yeah, I completely agree that it's one thing to literally have text somewhere on a website, and it's another thing to have a clear, transparent, and comprehensible and intuitive explanation of what's going on. We can follow up with you and send you materials that we've put together on this that show graphically what many parts of this look like, and would love to do that. But yeah, it's this should be something that is intuitive when it's displayed and that you can't avoid looking at before you start using the platform, because everyone knows that clicking confirm once for a giant scrolling box of text is something that people have gotten very good at doing.
That's right, myself included. I want to thank you very much. I look forward to getting that information and learning more, and I appreciate your attention to protecting consumers. Thanks very much, and I yield back.
The gentleman from South Dakota, Mr. Johnson, is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate it. My question will be for Mr. Lukin, and then Mr. Bankman-Freed can offer any contrary thoughts he might have. But, sir, I listened with interest to the exchange you and Ms. Adams had, where you noted this auto-liquidate model mechanism, particularly with regard to hedgers, could impose, I think you said, disruptive effects on the broader market. Educate me, help me explain what those disruptive effects could be. And again, maybe to people who are a few levels away from the transactions that are being reviewed.
Well, typically when there's a default in the marketplace, the FCM will take those positions and try to manage that default and making sure that either hedging those positions or making sure that it's not being dumped necessarily into the marketplace. Because the last thing they want to do is either disadvantage their customer and FCMs are required by CFTC regulation not to have an impact on the market. That is a rule. And so when you get into auto liquidation, there's not a lot of discretion or judgment there, right? You're having to dump into the marketplace according to the algorithm. So I think one of the things we're trying to explore with this new model, as the positions get bigger, and oftentimes hedgers have very large positions, as you start to put things into that auto liquidation feature, is that going to have, not only for the hedger, but for other people that may be hedged and that price of that product, it may have an impact. And so that's something I think we're considering. Again, for small positions, auto liquidation may not have a market impact. But as they get bigger, that's where we have some concerns.
There's been some insinuation, and probably even somebody said it explicitly, that this particular mechanism could create more cascading waterfall type impacts in a contagion type environment. That may be, I just don't know that I understand that that's the case. Why do you think it would have more risk for the system?
Well, it's like a typical financial run on a bank. As prices start to decline, defaults start to happen, you start to cover those defaults, more auto liquidation happens, and it starts to cascade. And what CCPs like to do, and I worked at the CFTC as acting chairman during the Lehman crisis. The futures business, by the way, was left whole. It was not the problem. Mm-hmm. But we were able to work slowly to move those positions to FCMs that could take on those positions. I know Chris was there in the trenches as well. But that's a way that we prevented a liquidation into the market so that the price and other futures hedgers weren't impacted.
The FTX proposal, though, has some of their capital in a reserve, I think, to be able to respond to some of these situations you're talking about. Is the suggestion then that that's an insufficient degree of capital?
It's hard for us to know. I think, they have scaled that, and it's a significant amount of money. However, for us, you're really trying to measure extreme but plausible situations. And whether 3 of their largest clients is extreme but plausible is a little different than the FCM model, where they are extremely large. If you take 2 of the largest FCMs, that's 1/3 of the volume on an exchange. I don't think the FTX model necessarily that cover 3 is extreme but plausible. I think that's worth exploring and understanding better.
So, Mr. Bankman-Freed, the allegation has been that is not a sufficient capital to cushion systemic risk and impacts. Your thoughts?
First of all, I agree with a lot of what Mr. Lukin said, and I take his questions here in good faith because they're important. Here's sort of my sense of them. First of all, I'll note that our liquidations are partial. We go piece by piece. This is not, this doesn't solve all problems. At the end of the day, if a position needs to be closed, it needs to be closed. But we do take measures to attempt to do less if possible. We also, I'll note, Mr. Lukin pointed out correctly that there are a lot of cases where it can be helpful to have an institutional party which manages a position rather than liquidating it We do have two systems in place for that. The first is the backstop liquidity provider system, where there are institutional trading firms that are passed off positions in extreme market conditions if the order book can't handle them. But the second is that we do have optional intermediation where FCMs are welcome to play that same role with their clients, where they can post the margin for the position and then work with their client or themselves or however they want on managing that. So we do have that as an option. I'll say on the amount of collateral here, I do actually think that the top three users on the exchange are going to be quite large. That is true if you look internationally right now. That the top few users are a significant fraction of volume on the exchange. These are generally either large intermediaries or large global multi-asset class trading firms. But I'll also say that the amount that we put in the guarantee fund is way above what this standard would have required by a pretty substantial factor.
It's expired. And now the gentleman from California, Mr. Garbahal, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you to all the witnesses testifying before our committee today. It is extremely important that the U.S. is a place that innovation and digital assets can flourish and that U.S. consumers can enjoy the financial benefits associated with cryptocurrency. It is also, however, absolutely critical that innovations do not come at the expense of consumers. There must be protections in place to safeguard consumers so that they do not face financial ruin while some companies profit off of that loss. I think digital assets entice a lot of people because they offer an opportunity to quickly make a lot of money. But as in this case, with any investment, not everyone will see the level of success they hope for. I know that whether you invest in traditional stocks, trade, derivatives through a traditional clearinghouse, or purchase digital assets, there is always a risk. Mr. Bankman-Freed, I think I am on the same page as you that increasing equitable access to markets is a good thing. You noted in your testimony that all users should have equitable access, quote, so long as they are sufficiently informed and can demonstrate they understand what they are trading, end quote. To that end, what steps is FTX taking to ensure new users, specifically retail users, who may not be as experienced as traditional client base, are informed and able to demonstrate they understand what they are trading? How will you ensure individuals fully understand the risk they're taking should they choose to trade cryptocurrency on margin?
Thank you for the question, and I completely agree that that is incredibly important. The first thing that I will note is that the majority of the low engagement retail users who are not sophisticated traders do not access leveraged futures on the platform. They don't do that internationally today. The majority of them are accessing the spot markets, and we anticipate the same thing in the United States. It is worth noting that today on the futures markets in particular, over 90% of the volume is coming from users trading at least $100,000 per day. And so the bulk of the users here are larger users. All that being said, in addition to having the, a large amount of transparency and disclosures and material, there's a mandatory walkthrough before you can trade on the platform, which explains how it works, how the products work. And for smaller users, a quiz that you have to take to demonstrate that you understand how this product works. And we think that demonstrating understanding of the product and the exchange is an appropriate and extremely valuable test for who should be accessing this product while still allowing equitable access to the disadvantaged.
Thank you. That's very encouraging. Mr. Duffy, I agree that innovation must not fail to protect the consumer. As the digital asset market continues to grow, do you see potential ways for the clearinghouse model to evolve to better accommodate cryptocurrencies?
I would absolutely say yes to that, sir. I think that there's always ways to evolve the clearinghouses to manage risk. And again, I'm not opposed to innovation at all. I'm not opposed to the direct clearing model, as I've said. I'm opposed to an application that does not allow all of us to participate and everybody to come together to see what this market structure is about. I am here to discuss market structure. I'm not here to discuss the value of cryptocurrencies or blockchains or any other thing else. I'm here to talk about market structure. And if I may, can I please, for the record, sir, Mr. Chairman, if I may make the following statement. When I was getting badgered by your former colleague, asking me a bunch of different questions, he was cherry-picking my testimony, but what he failed to say that when I said there's no capital being held at the FCM. Today, there's capital of $170 billion, you heard from Mr. Lukin and others. So the gentleman was completely wrong when he said that I gave false testimony. I gave absolutely correct testimony. There is no capital being held at the FCM under this proposal. So I just want to make sure I cleared the record. I apologize for not answering.
Thank you. You did take up my time. But
No,
I'll
I
accept your
apologize. I hope the
apology.
chairman will give it back to you.
With that, Mr. Chairman, I yield back.
All right, that's fine. Thank you. And thank you, Mr. Duffy, for clearing your record. Thank you. Now the gentlelady from Florida, Mrs. Comic, is now recognized for 5 minutes.
Well, thank you, Mr. Chairman. And as the millennial in the room, well, I guess now there's 2 of us in the room, I want to open up with saying, as a disruptor, I like disruptors. And I think it is very clear, given the amount of comments and feedback that we have received and the CFTC has received on this very rulemaking process, that there's a lot of interest and a lot of concern and vested interest in this process. So looking at how 95% of crypto derivatives and the trading volume occurs outside of the United States, I'd say that this is an opportunity. And I like opportunities. I believe America is based on equal opportunity, not equal outcome. So there are some issues that we need to overcome, and I think we can. And I believe that innovation is going to be absolutely critical as we move forward. So I'm going to dive right into it. We don't need to separate y'all, do we? All right. Well, it's been a very colorful hearing thus far. So we're looking forward to all of the feedback from you all. Mr. Bankman-Freed, how are investors impacted by the current system in which derivative marketplaces demand users to pay for market data, order books, and market access?
Yeah, I think that it makes it very hard to have the same level of access as a smaller user as the largest trading firms have. It means that you don't get to see what's happening in the markets you're sending orders to. It means you don't have the same transparency about what orders are in the book, about depth. You don't have this, and that's all relevant trading information, which is gated on the amount that you're willing to pay for it. It also means that price discovery is not made fully public, and that is one of the core goals of marketplaces in addition to hedging. And so I think that, those are all reasons that and I'll add one more as well, which is I think, frankly, it increases operational costs to have gated market data. It's not always well defined exactly what it means to use market data, exactly what it means to consume it. I know firms that spend large fractions of their time arguing with other platforms over exactly what market data is required, exactly where, and licenses is required for that. And I think it's also just cleaner and lets people innovate on our data if they want to make it open.
Well, and you answered 2 of my follow-ups, so thanks for that. Would the FTX, or I guess how would the FTX real-time risk management of margin products affect market risk and asset volatility, especially during times of market uncertainty, like we've seen with the war in Ukraine, for example?
Yeah.
And I'll throw another one at you. So would it have prevented your system, would it have prevented the what we saw with the nickel futures and that market meltdown with the London metals exchanges?
Yeah, thank you. I do think it would have helped prevent that. And the way I see it is that if you have a real-time, precise risk engine that knows the exact amount of collateral that a user has and can act promptly, I think it's often viewed as being punitive to the user. I don't think that's how it is. I think what it means is that you don't have to preemptively liquidate them out of fear of where markets will move, and it means that you don't have to ask for as much collateral at the beginning, or if you do ask for the same amount of collateral, that they have a much bigger buffer before their position would be in danger of liquidation, given the promptness with which it can act. And it means that you can operate a model without recourse, so that people know that they can't lose more than they deposited to the platform, that they're not worried you're going to go after their bank account or their house. You can accomplish all of those things much more cleanly with a real-time risk model that can wait until a position is nearing being out of margin before closing it down, while still preventing systemic risk and being non-recourse. I think those set of things would have helped substantially prevent what we saw with the LME nickel futures, where, first of all, it was unclear where the collateral was, if it was even there. And then it took days for the exchange to figure out what had even happened, by which time nickel had kept moving. The position was billions of dollars underwater before there was any transparency to the system on what happened. And so I think all of these would likely have helped mitigate that.
Well, thank you. I've only got about 30 seconds left, and Mr. Edmonds, I have a very lengthy question for you, so I'm going to have to submit it for the record. There just simply isn't enough time to really cover what we need to cover here in talking about market structure and this proposal. So I'll, with 13 seconds left, Sam, you mentioned that you're not getting interested, in your words, into getting into the ag markets anytime soon. Can you explain that just a little bit?
Yeah, I mean, I think I'm interested in the markets, but I think they need more analysis. I think, as other people have been pointing out, different market structure, different settlement, different timing. It just needs more thought.
Thank you.
Thank you very much. And the gentlewoman from Virginia, Ms. Spanberger, who is also the chair of the subcommittee on conservation and forestry, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. I have appreciated this conversation. It's been incredibly interesting. So thank you to our witnesses for participating. Ms. Kamek, I should have additional time if you'd like for me to yield to you to continue your question. I'm happy to do it because I have so many questions. I actually want to just diverge completely and speak from the perspective of someone who's the chair of conservation and forestry. I really just want to have a general conversation, though quick, because I've already offered Ms. Kamek my time, about the impacts of digital assets, particularly cryptocurrencies, have on the environment, and really what these investments mean potentially for sustainability. We know, according to the University of Cambridge, Bitcoin mining alone requires 132.48 terawatt hours of energy annually. And for context, this energy use easily surpassed the annual energy use by the nation of Norway in 2020. So roughly 35% of all Bitcoin mining takes place in the United States. And according to the Energy Information Agency, this is translated into roughly 40 billion tons of carbon dioxide produced by U.S. Bitcoin mining in 2021 alone. Certainly, Mr. Bankman-Freed, I know that you speak to the commitment of carbon neutrality in your testimony, but I would like for you just to expand on that a little bit. Like, how can we make sure that we're forward-looking, as we're looking at a forward-looking technology, et cetera, that we're also finding opportunities to really reduce emissions? I think people don't think about the environmental impact of Bitcoin, but I do think it's a serious issue to consider.
Yeah, thank you for the question. I completely agree. And, there's one part of this where we do buy carbon offsets, and on top of that, we, invest in R&D. Let's put that aside for a second, though, because that can only scale so much. In the end, my real answer is that, if you would see the crypto industry scale 10, 100 times as big as it is today, it would be insane for the energy usage to be scaling that as much as much as well for, the reasons you're pointing out. I also don't think it would, and the reason is that while Bitcoin is a proof of work blockchain that is energy intensive, most other blockchains are proof of stake blockchains that have effectively no energy cost to them. The bulk of transactions already are happening on low cost proof of stake blockchains. And for economic reasons as well as environmental reasons, those have to be the ones that scale. You can't be paying $10 for every transaction in a scalable system. And so while Bitcoin may or may not end up being a large store of value, don't want to give investment advice or anything, that doesn't mean that it has to be the blockchain on which millions of transfers are happening per second. And to the extent that blockchains do grow in size, I think it has to be and will be the low-cost proof-of-stake networks that will not be expanding the climate impact of the ecosystem.
Thank you. I might follow up with additional questions for the record, but as I've offered my time, and I'm curious to hear the question, Ms. Kamek, in the interest of bipartisanship, over to you.
Well, thank you, Representative Spamberger. I appreciate you yielding your time. This is a little bit in the weeds, so bear with me here, all right? Mr. Edmonds, you noted that, quote, FTX participants lose their positions when markets move against them and they are liquidated at adverse prices, end quote. But some market participants in volatile markets, especially agriculture markets, have noted a similar effect occurs with exchange circuit breakers when trading is halted for the day if prices move too much. In traditional markets, significant volatility plus a halt in trading can result in large, unaffordable margin calls at the end of the day. If a participant cannot make their margin call, their position is liquidated and their initial margin is taken up to make up the difference, both closing out a potential hedge and costing the participant their initial margin. But the real kicker comes when the market reopens and the volatile price swings back the other way, returning the now liquidated position to profitability. How different is that scenario under traditional markets from the scenario that you laid out in your testimony? In both cases, the hedger is out of a hedge and collateral.
Right, but in the...
Sorry, I know that was a mouthful.
I'll try to be as brief as possible. In the traditional marketplace, you have the FCM, in most cases, intermediating that relationship. They may, in certain circumstances, extending you credit based on their knowledge of your known physical position. And they see that, and that is a relationship you have, and that is a credit relationship you have with that intermediary here. There is no chance for that in the case here. I would also say in the volatility, as to the point of volatility, the price in the morning can be very against your position. And a few hours later, that position, before the market session closes, can come back into your position. In this case, with auto liquidation, you've already lost that. In the other case, you're going to have that position on an overnight when the market closes and the price is set, and you're going to determine whether you pay for that or not, and that's going to be between you and the relationship you have with your FCM.
Well, and I know I just ran out of time. I would love to get your rebut to that as well, just so that all of us can really understand all sides of this. But with that, I yield back unless any other members want to yield their time.
The gentleman from Georgia, Mr. Allen, is recognized for 5 minutes.
Thank you, Mr. Chairman. And, you know, the market's very volatile, as we know. In fact, Mr. Freed, you've had a tough couple of days here. In fact, it reminds me of the story in 1987. I think Sam Walton, which we all know, was the first investor to lose $1 billion in a day. And he was asked the question, my goodness, what are you going to do? And he says, well, it's only paper. And we're still in business. So with that, Mr. Duffy, obviously we are seeing tremendous fluctuations in, obviously, the market, crypto, otherwise. From how your protections, how much are they fluctuating?
Which product are you referring to?
Your collateral.
Sorry?
Your collateral.
My collateral at the Clearinghouse fluctuates. It's probably sitting at about $225 to $240 billion right now, sitting in my Clearinghouse protecting positions on the exchange.
Okay. As I understand, the purpose that we got into this business was to get rid of volatility for our farmers. In other words, you know, they produce a crop, and they, you know, make a substantial investment to produce that crop, and so they needed to know about what that crop was going to be worth when they harvested, and of course we had what happened in 1982, that we lost a lot of our agriculture industry in that one sweep. And of course we started coming up with other ways to stabilize the markets. And of course your system, I think there are two companies that largely have been in this business to stabilize. A farmer comes to you, he says, you know, I'll sell my corn at this, you place it, and then, you know, the risk is appropriately shared. So how much fluctuation, like we're talking like Mr. Freed there, I understand it was half of his value was lost. What would it represent as far as your market and your collateral? Like, would it be 10% down or 20% down, or based on these fluctuating markets right now?
The fluctuating markets in the agricultural markets?
Yes, sir.
Very de minimis, sir. Very de
Okay.
minimis.
So it's not negative, which is what we're trying to accomplish with this whole
Yes, sir.
business anyway.
Yes, sir. It would be very, very small.
Yeah, and the other question, Mr. Freed, for you is you have submitted an application to the commission for approval. Why is that application incomplete?
Sorry, why is it incomplete?
Okay, well, you're saying that there are other measures that need to be implemented to sustain your collateral. And you're looking for guidance from the commission on that? In other words, let me understand what you're up to here. You're asking, you are the one that's coming to ask for approval, yet you're basing your approval on whatever the commission says you have to do. I would think you would have all of your ducks in a row before you submitted the application.
We do think we have all of our ducks in a row.
Okay, so then why do you think the commission is going to require you to do other things?
What are you referring to?
Well, I don't know. What I gathered from comments my colleague from Georgia, Mr. Scott, said about from your collateral standpoint and the fluctuations, this commission's, because again, we're talking about agriculture here, the farmer, and stability. How are you going to provide that when you're seeing these fluctuations in the market?
Are you asking how we would provide to agricultural products in particular, or are you asking about the collateral volatility? I'm sorry, I think I don't understand what you're referring to.
Okay, well, we'll try to educate Mr. Freed on how agriculture works. Thank you, and I yield back.
Thank you, Mr. Allen. And now the gentlewoman from the U.S. Virgin Islands, Ms. Plaskett, who is also the chair of the Subcommittee on Biotechnology, Horticulture, and Research, is recognized for 5 minutes.
Thank you so much, Mr. Chairman, and thank you for you and your staff's leadership in assembling this really great panel of witnesses for us to try to understand and dig into what is happening at the CFTC, what is happening with regard to the commodities exchange, and what is actually going on within crypto. You know, a little earlier in the discussion, I was right there in the hearing room, and one of my colleagues said that he had decided that he had made maybe the wrong decision in terms of his career choice, and everybody laughed. But we recognize that those of you who are witnesses are there because you have attained a level of intellect and a level of understanding of these that doesn't come very quickly. And to make such a statement to me really reveals a kind of sense of failing forward. There are those of us in our society who are allowed to fail forward and those of us who are not, who do not have that luxury. And I feel it's part of my responsibility to be concerned with, one, the consumers who may fail forward and fail because of the activities of all of the witnesses that are here today. Whether it's, a commodities exchange that has kept certain classes of farmers out of the benefits over 100 years of the use of the commodities practice and commodity farming, or whether it's the young individuals who are underbanked who see crypto as a way to gain wealth, which is very tenuous at best for them. And so I believe that we as members of Congress have a responsibility to safeguard all of those areas. And so some of the questions that were, and the testimony I thought was very instructive to me. Mr. Perkins, one of the things that you discussed in your testimony was that you did not believe, that there was negative impact of embracing the innovation and lack. However, some guardrails needed to be put in place. What guardrails, have you thought about that? What the guardrails might be that would be best to put in place to ensure safeguarding of and allowing the innovation and then now allowing this growth in technology while preserving the American farmers, as well as those individuals who even engage in cryptocurrency?
Thank you, Congressman, for your question. Related to the issue at hand with central clearing, it would be my belief that the same principle should be applied to FTX as is applied to the CME and everyone else. And so when you look at ways to collateralize the system, it should be extreme but plausible. We need to make sure that there are sufficient disclosures for people who understand the risks of participating as well. But if you step back, I think it's imperative for all of us to make sure that people are educated not only on the risks, not only on the opportunities, but also the risks of entering into these asset classes. And I think, I look forward to working closely with regulators on ensuring that the approach is always principles-based, right? And listen, the CFTC today, they have full authority to police issues of fraud, manipulation, and abuse. We should have very little tolerance for those types of things in this environment, along with the other regulators.
Can I say, thank you for that. And, I agree with you. And I think the education portion is very important. I'm always very, very skeptical of a new product or a new scheme that is actually even attempting to go after minority communities, individuals who have been kept out. Why are they all of a sudden being allowed in? It could be altruism, but it could also be to their detriment. One of the things that I think has not been asked by to Mr. Bankman-Freed is, sir, one of the discussions is that we should have followed a longer process, the regular process that CFTC does, which is to have public comment, regular rulemaking. Would you be averse to a discussion of regular rulemaking?
So I think we have followed along with the standard CFTC process. It is not standard.
I think that they created a process that is a little ad hoc for you, but it does not follow the regular public comment period.
I don't think that it is normal to have rulemaking as part of a margin order amendment. I think that's actually quite unusual. I think it is unusual to have a House hearing as part of a margin amendment. I think it is unusual to have a public roundtable. I think it's unusual to have a public 60-day comment period. To the extent it is unusual, it is in the increased transparency and thoroughness of it rather than the opposite. But I would be happy to follow up with you after and go through cases and see what the standards and precedents are here.
Thank you. And I have quite a number of other questions, Mr. Chairman, but I'll save those for in writing. And I want to thank you again for allowing us this opportunity.
Yes, thank you, Ms. Plaskett. And now the gentleman from Texas, Mr. Cloud, is recognized for 5 minutes.
Thank you, Chairman, for this very informative committee hearing, and thank you all for participating in it and sticking through it for this long. It's been a lot of fun for me, maybe not so much for you all, but it's been very, very enlightening nonetheless. And whoever's idea it was to sit y'all two gentlemen next to each other, genius. No, no, but it is very helpful to have the back and forth. So many committee hearings, it's kind of the debates decided before we actually get to the committee hearing. And this is one, I think, where your expertise and your wisdom weighing into this is extremely helpful to us who are trying to grasp this new developing technology and how it would be. Speaking of first principles right off, I'm concerned any time about the government stepping in and picking winners and losers. I think it's important that we don't stop what would be disruptive technologies just because it protects the status quo, especially when the status quo is a middleman. And I'm just speaking broadly here, but also am very concerned about the government stepping in and endorsing one business model as well, and what that would mean. And especially just in the context of where we're at right now, you mentioned the food shortages, which I wish this committee would focus more on. And right now we have a White House more concerned about disinformation than we do baby formula and those kind of things. And so very concerned about that. We need to spend more time on that. And to have a disruptive technology in this window is a concern to make sure that that doesn't go wrong. If y'all could help me with this, kind of entertain me, Mr. Bankman-Freed, if I can see it correctly, and Mr. Duffy, if y'all could each kind of do this for a second. If we were to assume that his model was going to be accepted, what would you say, okay, let's do that, but these are the provisions that we've got to got to consider. And likewise, if it was to not be like, okay, what's the considerations here about the future that we're not creating, the things that we're not protecting going forward? If y'all could.
I'd be happy to start if you'd
Okay.
like. If Mr. Bankman-Freed's model was to be accepted, I would say a couple things. One, it needs to go through a regular rulemaking process to answer the gentlelady's question earlier, because it's not just a margin model. This is a market structure issue that affects the entire industry, not just margin. So that's for starters. That's the reason why it needs to go to a full review. So the gentlelady was correct. So what would happen, what I do, if in fact it got passed, I would implement the model myself. And I do not think it's appropriate to do at this given time. I would want to implement the model, if it was approved, with the communities that's affected throughout the globe that trade these global markets in nature. That is critically important to make sure that people are brought into the process and not surprised by the process. So I'm not opposing it. I'm saying let's do it in a way that makes sense for everybody.
Yeah, one of the things you mentioned too was weekends it seemed to be a concern that kind of came up. I mean, one of the little pragmatic things. I know that's not a systemic thing, but how much of that is part of
systemic risk in
weekend trading?
I'm sorry, I didn't hear that. Weekend trading. You know what? I guess for some people there is no systemic risk. I know Sam likes to kind of go 7 days a week hard. There's other people that are in our farm community and others that need a day off, and they really don't want to be interrupted with their hedges being auto-liquidated and the time where they're trying to at least take an hour off from their day of providing food for their country.
Yes, thank you.
Thank you. So, in terms of what would happen, and I think I want to talk less about our application in particular. I'm taking this as a policy question rather than a competitive or anti-competitive question around our company in particular. I think if in general there were not to be licensure of digital asset platforms in the United States, we would continue to see a regime where the United States is the only developed country that cannot access deep liquidity in crypto markets, that cannot access hedging for them. It's the only developed world in which there is very little federal oversight of the digital asset marketplace, very little anti-fraud, anti-market manipulation oversight, no clear federal regulator for the majority of the platforms. And it would mean that this industry would continue to grow offshore rather than here, with oversight to the from offshore regulators, not from our regulator. It would grow in other currencies as the base currency for the crypto ecosystem rather than the US dollar. And I think that all of those would harm American consumers and the American economy.
Thank you. Mr. Lukin, I wanted to get to you, but I only have 5 seconds. I'm really curious to your thoughts because I've seen you nodding on all sides of this argument, and you were the only one that I heard use ag and livestock references, metaphors, and so I know this committee really appreciated that. So, do you have a quick? Okay, thank you.
Thank you. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member. This is quite interesting. Mr. Bankman-Freed, you mentioned in your testimony that FTX would utilize real-time liquidation features to prevent the buildup of risk in the customer portfolio. How will this risk management and liquidation affect market risk and assets vitality, especially during the times of market uncertainty, as we are seeing what's going on in Ukraine?
Yeah, thank you for the question. Derivatives markets can help to buffer volatility, to reduce it, and to add liquidity. They can also help exacerbate volatility, in some circumstances or if poorly defined. I think that our model would help reduce volatility and increase liquidity. And the reason for that is that by having precise knowledge of the collateral in the system and having a fast margin engine that can act swiftly if needed, it allows the risk engine to avoid having to liquidate positions that might not need to be liquidated until it becomes clear that they are in fact nearly out of collateral, while also still successfully closing them down before an account would go bankrupt. And so I think it does a good job of balancing against the market risk and the systemic risk there, which is massively harder to do if you have less transparency, less clarity, and a less fast-acting risk system.
Okay, thank you very much. Mr. Perkins, I think it was stated earlier that the U.S. lagged behind other countries in the adoption of digital assets, with over 95% of the trading volume occurring overseas. The question is for you, and maybe some of the other panels can speak on it. What factors do you believe are preventing the growth of cryptocurrency trading in the U.S., and how would American, particularly farmers, benefit from these type of trading platforms?
Thank you for the question. I think one of the reasons why we haven't seen derivatives migrate into the U.S., regulated derivatives for purposes of risk management, is because the current structure as it exists today is inadequate to handle the volatility of the products. The risk builds up with the FCMs, the intermediaries, and they simply don't have the capacity to offer this hedging mechanism to clients. And to the extent they do, they can only give it to their tippity-top clients, which isn't very good from an inclusive perspective. And so I welcome innovation that we're seeing, like with this direct model, which does look at things such as thoughtful risk management, inclusion, and competition. And how will this benefit community members? I think competition will lead to better pricing. And in fact, you're eliminating the pricing of the intermediary. So I think it would be very beneficial to endorse a model such as this to allow our communities to hedge their risk.
Anyone else on the panel would like to make a statement on this?
Well, I would take a little issue with the idea that, the demise of the FCM, that they're not able to handle access. I mean, there are plenty of firms under the current clearing system that handle retail clients, that handle retail crypto clients, we have exchanges that are offering products for crypto. So certainly this is another method for access, but we have lots of great firms that are willing to take on these clients in our industry.
Okay, thank you. One other question, and this is for Mr. Bankman. If the Commodity Future Trading Commission approve your proposal, do you have mechanisms and programs in place to address the barriers small and socially disadvantaged farmers may have to utilize this platform and exchange?
Sorry, could you repeat the last bit?
You have the mechanism and program in place to address the barriers small and socially disadvantaged farmers may have to utilize the platform and its exchange.
Thank you. Really important question. And I'll say it's really important that we have transparency, disclosure, education, suitability, and testing on the platform to ensure that the users do understand it. But at the same time, it's really important that disadvantaged communities are able to get real financial access in a way they have not historically had an easy time doing. We offer the full product suite. We offer it on online, we offer it on a phone, we offer it via API. We offer all the tools that you need to do it. The compliance is built into it, but you can fund it directly. And we are actually overrepresented in minority communities on our platform.
I yield back, Mr. Chairman.
Thank you, Mr. Lawson. And so, gentlemen, we come to the end of this extraordinary and very beneficial and informative hearing. And I want to thank each of you. We're going to do two things. I want to see if our ranking member would like to make a closing statement. And then I will make my closing statement on what we have experienced today. And first of all, here's our ranking member. And I was just letting them know the order. You have but before that, I want to thank each of you. I want to thank you, Mr. Terry Duffy, Chairman and Chief Executive Officer of the CME Group. Your testimony was very, very helpful. I also want to thank you, Mr. Sam Bankman-Freed, who is Chief Executive Officer and founder of FTX US Derivatives. Thank you for your informative and helpful presentation. Our other witness, my friend, Mr. Walt Lukin. We've worked together over a number of years as you were chairman of the CFTC when I was chairman of our Commodities and Futures and Exchanges Subcommittee. Thank you. And our fourth witness was Mr. Christopher Edmonds, Chief Development Officer of the Intercontinental Exchange, which we all affectionately call ICE. And our fifth and final witness today, Mr. Christopher Perkins, the president of Cohen Funds Management, LLC. Thank you for your very helpful and beneficial presentation and testimony. And before I give my closing remarks, I'm going to turn it over. He's writing feverishly, getting all of them down. Our distinguished ranking member, Mr. Thompson of Pennsylvania, and then I will end it with my closing remarks. Ranking member?
Chairman, thank you so much, and each of the witnesses, thank you for being here. I appreciate we were able to do a balanced hearing on an important issue. CFTC. Actually,
please mute phones, please. Members, thank you.
All right, thanks, Chairman. The Commodity Future Trading Corporation is empowered to use a transparent, principle-driven based process to consider any proposals, including the ones submitted that was a point of discussion today, although we did talk a little more broadly on quite frankly, that process. And I think the process is the important part of the discussion today. I'm hopeful that this transparent, principle-driven process, the CFTC, that the discussions today may be informative. And we heard a diversity of views, and so that's my hope that what we heard today will help to be informative of the process that they're engaged with this specific proposal. CFTC must ensure that stakeholders and the public have a seat at the table. The Agriculture Committee's role is not that decision-making, it's oversight of the CFTC. To include where the CFTC fails to follow the appropriate process, then we have a role. That's part of our oversight role. Where the CFTC would deviate from the law, we have a role to play. Where the CFTC unnecessarily limits debate, we have a role. The Agriculture Committee has a role to play. But let's be clear, none of this has happened. None of this has happened so far. We've had, CFTC, my understanding is we've had right around 1,000 comments have been received when they publish for public comments. I'm assuming that a number of those, hopefully a lot of them will be instructive and informative in this process. The stakeholder roundtable is scheduled for later this month, 25th of May, so that's much appreciated. They're going to bring experts to the table to really kind of do an analysis of those public comments. As the House Agriculture Committee, the trading of traditional agriculture commodities obviously is critical, and that's why CFTC was born within the U.S. Department of Agriculture. But as we saw how effective that was, other commodities were added to under the CFTC's jurisdiction. So our jurisdiction over the CFTC provides a responsibility for other critical commodities: energy, gold, digital commodities. And I have confidence in CFTC that the Commission will continue their informed, transparent review of this proposal and all other proposals. This is not the only proposal, obviously, they received and will receive in the future. That's why the process, making sure the process is is the way it should be. That's why it's so important. I would be remiss if I didn't encourage every member of this committee, and this is outside of this issue, but to join Mr. Khanna and myself as a co-sponsor of H.R. 7614, the Digital Commodity Exchange Act of 2022, that would establish effective oversight of digital commodities, defined oversight of digital commodity markets with our without diminishing the innovation and the creativity that has established, quite frankly, as you know, the United States is a global leader in this field. And so to the witnesses, once again, for your testimony, and Mr. Chairman, thank you so much.
And thank you, Ranking Member, for your excellent closing remarks. Ladies and gentlemen, and again, thank you, all five of you. You've been extraordinarily helpful. First, I also want to thank my committee staff, who's worked hard to pull this together. They've done an excellent job, and I'm most grateful for their hard work on this. What today's hearing showed us is that we have a serious issue here. What concerns me is we have got to make sure that we have the protections there for our clearinghouses, because they are the anchors for dealing with this growing derivatives market. The other point is that this is international. And ladies and gentlemen, we have enemies out here. You got Russia, you have Iran. I guarantee you they're watching this hearing. They're all looking for, not just them, the Revolutionary Guard of Iran. They are looking for ways in which to weaken our financial system. This is what makes us the greatest, most powerful nation on this earth. And the good Lord has blessed us with bountiful agriculture, which is the major piece of derivatives and swaps. They deal in commodities. And that's why this Agriculture Committee is determined to make sure that this is protected. Now, this new cryptocurrency, you've heard from the witnesses here. Everybody knows it's new, it is vulnerable, it is going through its growing processes. Nobody is against it. What we are for is to make sure we deal with this new cryptocurrency with its vulnerability, with its volatility. We've got to solve that. It cannot be handled and entered into our financial system until and unless we eliminate this vulnerability, this uncertainty. And so this is why I mentioned to the chairman of the CFTC when he was here and let us know he was dealing with this, to hold up until we could get this hearing going on. I appreciate that. We're all in this together, but I want you to know that we have enemies around this world who want to destroy this nation. And the one most vulnerable way, history is cluttered with the wreckage of great nations because they did not protect their financial systems. And so, with that, I wanted you to know the importance of this hearing, and you all have delivered to us valuable information.
And this committee, as you heard from the questions and the differentiation, are very much concerned that as we go down this road, we go down to it with the understanding that the future of our nation's security is in our hands. Thank you all very much, and I look forward to working with each and every one of you as we move forward. Thank you. Now, thank you for that. I must take care of this business before we go. Under the rules of the committee, the record of today's hearing will remain open for 10 calendar days to receive additional material and supplementary written responses from the witnesses to any question posed by a member. Therefore, this hearing of the Committee on Agriculture is adjourned. Thank you all very much.